All right. Good morning, ladies and gentlemen. My name is Vihan Singh, and thank you for joining this two-day webinar. So it's in two parts, 3 hours today and 3 hours tomorrow. The webinar is titled No Nonsense Quant Trading. And as the title suggests, my objective here would be to deliver content to you guys that is without any kind of, padding or any kind of, uh, you know, you know without beating around the bush. It'll be very very straight up actionable information, and which you can, today or tomorrow itself, you can, start using that information, and within next week you could be hopefully making money out of it. Everything here is going to be strictly quantitative or systematic in nature, so no discretion is required from your end. You don't have to think about when to take a trade, when not to take a trade, whether you should buy, whether you should sell. All of that will be in a strictly rules based framework, that if X, Y, and Z happens, do this, and if A, B, and C happens, do that. You will require absolutely no discretionary or manual input from your end. Hence, everything that I'll teach you will very much be amenable to automation. um, so what is the content for the 2 days? Today I'm going to, so essentially the focus for both days is going to be on options trading, specifically on expiries, right, on Thursdays. So, and again, for people who have joined who do not have, you know, too much of a trading background, don't have knowledge of options, um, I would suggest you just, and now especially that you've gotten in, just hang in there through the end of the webinar, because even though some things might not make sense, I'm sure at least the overarching ideas would. And, once you go back and you start looking those things up, it won't be too hard to get up to speed, right? So, however, I'll, over the 2 days, I'll try to build everything up from first principles, or at least, provide a review for anything that I feel might be unclear to people, or people might not be familiar with. However, there is, certain limitations on time that we have, so I can't do like a review of a review. So I can't sit down and start explaining to you what an option contract is, what a call is, what a put is, what the Greeks are, when does a option contract expire, or at least the weeklies expire, and how all of these things work. um, uh, like that is not going to be part of these 2 days. You should, if that is something you would like to study up on, or get acquainted with, or get familiar with, I have like a webinar recording from earlier called Options Mechanics in Greeks, which is already there on YouTube on my channel, which you can watch. And for the people watching the recording of this on YouTube, I'll put the link in the description to the Options Mechanics in Greeks webinar. Right. So, like I was saying, the content, it's specifically going to cater to expiry trading, which is trading, usually on Thursdays. And, in case Thursday is a holiday, then Wednesday, and, Wednesday and Thursday is a holidays, then Tuesday, whatever. Right. So that's what the, the focus, so to speak, is going to be. And we look at it from both ends. Usually people have a bias towards, either selling options or buying options, and I don't really know why people have this. I think it's a very stupid idea that you have to be an option seller or an option buyer. You have to be, a delta trader, or you have to be a volatility trader, or you just eat, theta, or whatever. I mean, there's absolutely no reason to bucket yourself in any of these. I'm an options trader, or I'm a, um, you know or I'm a futures trader. So there's no point doing any of this, right? Just do anything and everything that makes you money, right? And especially in today's time, where you can, automate things. So, granted, if you're trading manually, you can probably trade, one or two strategies, or maybe three strategies simultaneously, depending on what the trade frequency features. However, but once you have the power of automation at your disposal, which today a lot of platforms are making available even to, the retail traders, at a very affordable cost. uh, I think there's absolutely no reason why you should sit down and do your trading yourself when the machine can do it for you, right? And that opens up the entire spectrum of how many strategies you can have deployed at any given moment, right? You could have 100 different strategies trading 100 different things, and you have nothing to worry about. So with that said, today's subject, or today's subject matter is going to be option selling, specifically straddle selling on expiries. And tomorrow's subject matter is going to be option buying, which is going to be directional option buying, right? Directional meaning that you'll either buy a call or a put. Straddle, of course, being where you sell a call and a put, or buy a call and a put uh, simultaneously. Because we're selling straddles, we'll be selling a call and put simultaneously. Now, the kernel for today's idea is based, or is very similar to what Akash sir shared in last week's webinar. Um, Now, if you guys aren't familiar with that webinar, please do watch it. It's on my YouTube channel, and follow Akash sir on YouTube. He's I've said it before also, he's like a god amongst men when it comes to strategy design. And he has, very simple conceptual thinking about the markets, and that's what he builds his strategies on. So like, somebody worth following. Um, Also, yeah, I mean, so that's about it. Uh, so before, so Akash sir's YouTube channel name is called, I think it's called High on Trading, or High on Markets. I'm not 100% sure, but it's something along those lines. And if you just watch my, or if you open the video of last week's webinar on my YouTube channel and go to the very end, there's a follow-up that he uploaded to his own channel, to the webinar. And there you can essentially reach his YouTube channel. Now, for the people who are asking me things like, is this going to be recorded? Yes, it is being recorded, and the recording will be on YouTube, but it won't be uploaded today. The recording will be uploaded after tomorrow's session also. So today and tomorrow's session, I'll combine into a single video, and then I'll upload it. So please don't ask me this again, and please don't ask such, I don't know why people in trading, especially in something like trading, which requires you to be aware, up to date on things, and very observant. People are so lost. I don't even know what they're doing in this field at times, right? Even with regards to people who were lost on how to join this webinar, right? Um, so I just think it's sad, and it's dangerous, for you guys, for those people who are very lost as they're looking to do trading. All right. So what I'll do is at least the way we'll structure this thing today is, um, and if you haven't, on Twitter, I have a post that outlines three simple steps that you need to take to become a successful, profitable trader, right? Number one being that you should have a profitable strategy, or a strategy with a positive expectancy, which basically means that if you follow this strategy over the long run, so in the next one or two trades, or the next five trades, you might or might not make money. We don't know, and we don't care. But we know that if this strategy is followed for an extended period of time, that may be 6 months, 12 months, any 2 or 3 years, you are, again, it's not guaranteed, but you're very, very, very likely to make money, right? So that's what a positive expectancy strategy is. That's number one. That's step having a positive expectancy strategy is number one to being able to become a profitable trader. Number two is having like a risk and money management system in place. So what does that mean? In any given trade, you can either make money or lose, right? Which is going to happen, you don't know. And if you have a positive expectancy strategies, what you do know is that if you keep taking trades into the future, down the line, you will make money. So with this information, it's like a logical next step to be able to create or take those trades in a manner that allows you to continue taking those trades into the future, because you don't know if the next trade is going to be profitable, so you don't want to bet your entire pot on the next trade itself. However, because in the long run you're gonna make money, it is in your best interest to create, or to trade in a way that ensures you're there to see the long run in the first place, right? Because if you blow all of your trading capital in the next trade or in two trades, then you can't really bet again, you can't trade anymore. So the objective of the money management or risk management system is to make sure that you're there to trade even tomorrow. So I forget where I read this, but it was a very nice way of putting it, that we know we're going to make money if we bet, and if we keep betting, and to bet, we need to have money. So you have to ensure, or like to bet, you have to make sure that you have your trading capital with you. So ensure that your trading capital does not get wiped out, right? That is the objective of your risk or money management system. So that's number two. So number one is, and like Ravi sir is saying, live to fight another day. So whether or not you made money today doesn't matter. What is important is you have something in your pocket that you can come back with tomorrow and bet it, right? So that's number two. Having a risk or money management system in place that allows you to play this game for an extended duration. Now, number three is execution, and as I like to call it, execution to the T, meaning that your execution should be spot on. Like, I won't use the word perfect or flawless, because like anything else, trading execution will also have some hiccups, some fuck ups every now and then. But by and large, you should stick to the plan that you've created. If you have a positive expectancy strategy and you have a sound money management and risk management system in place, then it is in your best interest to follow these rules that you've laid down and just stick to them. You should never uh, override these things, particularly to in a way to increase risk or change the trade that you're taking, right? For example, the system that you'd created said that you should buy, and for some reason you, or your opinion of the market or your opinion of the environment, says that you should sell, right? So you aren't allowed to do that, or you shouldn't do that, right? If the money management system says buy two lots, but for some reason you're very sure of this trade and you say I'll just go buy 20 lots, again, that is not something you should do, because with these you're increasing your risk, or you're trying to alter the decision of the system. In case of unprecedented scenarios, you are allowed to override systems to reduce risk. So, for example, these February, March type times where the VIX spiked up, and for example, you were trading options, say at the money options, right? And uh, earlier an at the money straddle was maybe like 300, $400. Now the same thing is over 1,500 or 2,000. So your if you don't adjust your risk in some way, and if you don't have a dynamic position sizing system, your risk could go off, right? So in that case, it might make sense to override the system to reduce your lot size and reduce your position size, so as to account for these unprecedented times you're in. But you should never ever override your system to increase the risk that you have on a trade, right? So if you can do these three things, create a money management, and sorry, for the first step, building like a positive expectancy strategy or creating a positive expectancy strategy, I specifically use the word build or create, as opposed to go ask somebody for a positive expectancy strategy, or read a book to get in a positive expectancy, or attend a webinar to get a positive expectancy strategy. So although this might be an exception, um, reason being, when you just buy something on the face value, right? Because you went to a seminar or a webinar and somebody said, this thing will make money, just go trade it. And they gave you very little or no explanation as to why something like this might work, how something like this might work, when would it not work. They just gave you some stupid ass rules, and you decided to follow them. What will happen is, any strategy is going to have some kind of drawdown, right? A drawdown being that you are going to lose money for some period of time, maybe 10 days, maybe 30 days, maybe 4 5 weeks, maybe months, right? That and being able to stick through that drawdown phase or that period where you're losing money requires you to have conviction in the system that you're trading. This often sounds like, hogwash to people who aren't actually trading. It sounds like a bunch of shit. If you just give me a strategy that makes money, I know I'll be able to stick to it. This is what you think until you actually start trading and there's money on the line, right? There's a big difference, especially in trading. Like, what you think in your head, what you hope is going to happen, and what actually happens can end up being three very, very divergent things. And these often are, until get some experience in the market over time. Now, can you get that experience for free, or in a painless manner? You cannot. Simply, like, experience will help you avoid bad decisions. However, experience is something that you'll gain often from bad decisions. So, I mean, don't be afraid of making bad decisions. Just don't make bad decisions that will chuck you out of the game altogether, right? Make mistakes, and this is something Ray Dalio says, that set like very ambitious goals, run after them, fall down, make mistakes, and get up, reevaluate, recalibrate, and run after them again. However, just make sure that those mistakes that you make, or those falls that you face, aren't falls that essentially wipe you out, right? Falling down to the floor is okay. Falling off your bed is okay, but falling off a cliff is probably something you want to avoid, right? Because that would be like a once in a lifetime learning experience, and probably the last learning experience you'll have. So that's essentially the idea, right? So create your own strategies, test them, and only deploy something once you have 100% confidence in it, so that even if you launch it today and tomorrow onwards you start hemorrhaging money in it, you have the balls or the conviction in it to stick with it, because you know that in the long run, if you just stick to this, you will make money, right? So build such a strategy, have a money management system, risk management system in place that allows you to stay in the game for an extended duration of time. So, and this is another, very long-winded way of just saying, be risk averse, or, trade from a risk first perspective. A lot of people are like, how much return can you give me? How much return am I going to generate? A better question is to ask is, how much risk will I have to tolerate, or what is the risk involved with doing this? And uh, this is this is like a tip I gave yesterday on the group also. And even I understand won't be feasible for everyone. However, if you really want to understand how to evaluate systems, and how to check whether a system is good or a trading strategy is good, take that trading strategy and try and pitch it to an institutional investor. An institutional investor being somebody who has a lot of money behind them, and has experience of the markets and trading, and does capital allocation on a professional basis. Again, this isn't something everybody will be able to do, but maybe a good approximation of it is, I'm not saying you have to disclose your strategy, but take the numbers and whatever, take the statistics, and try and pitch it to a friend. No, don't pitch it to people who are very likely to buy your bullshit, like your family members, maybe your mom or dad, whoever you're really close to, that you'll go to them and you'll show them whatever, and then just because they're close to you, they'll buy your bullshit, right? Don't do it with somebody like that. So an institutional investor is like the polar opposite in the spectrum. Like, they do not tolerate bullshit at all, and they're very quick to sniff out bullshit. So they'll be very what do you say, very harsh in evaluating whatever you present to them, and which is a good thing for you, right? Because if you can pass those tests, or if you can survive that rigorous grilling, then you're almost guaranteed that what you have is, I mean, it's not almost, like, it's not guaranteed, but it's very likely that you have something good on your hands, right? Because if this person who has a lot of capital behind them, and many times maybe they are managing, or their fund allocators for some other clients, and these are all very rich people, hence nobody wants to piss off rich people. And if they're trusting you with somebody's money, or even if with their own money, then you probably have something good on your hands, right? So step one, create or build a solid what do you say, positive expectancy strategy. Step two is to have a sound risk and money management system in place, and step three is to execute it to the T, right? My hope or objective over the 2 days of this webinar is to cover each one of these. right? I'll show you guys two strategies. The first today is going to be option selling, straddle selling specifically. Tomorrow is going to be option buying, where we'll be buying naked calls or puts. Both of these strategies are going to be used on expiry days, and I'll also try to give you, like, at least some reasonable framework for the amount of capital you should have, or how much you should be risking, so on. And with that, I'll also introduce to you a platform where you can execute these. Now, here's another thing: a lot of people have issues, right? I get messages all the time saying, "Yeah, I want to test this. I want to automate this. I want to back test, this strategy that I have, or this concept that I have. Do you, code up strategies for other people, so on?" There are many, coders out there who'd be happy to help you, right? And because coders today are dime a dozen. However, good coders might be harder to find, and even harder would be someone to find who knows how to code well, of course, and also knows about the markets, the market dynamics, and what all goes into creating a solid or a robust execution infrastructure, right? uh, Hence, um, it's much better to rely on one of these existing platforms, uh, if you want to find an instant, like, ready-made solution to your execution. Simply because if you go out and try to find someone to build this entire thing yourself, it'll cost you much more. It'll, both in terms of the development costs that will go in, the mistakes that you'll have to make to essentially refine this, and those trial and error process to get this thing right. And finally, just to deploy it, because having a robust execution infrastructure made and then deployed is an expensive affair. Um, so the first simplest option is to just use one of these, ready-made solutions, because somebody has made them for you. You can choose to rely on them. Like, it's not a bad thing. The whole idea of us making technological progress is that, and with these machines that we're making, is that it eases the load on us, or it reduces the amount of effort required from our end. So if somebody is giving you platforms that you can work with, of course, many of them won't be free, because even they have costs to cover, they have bills to pay, and they would also like to turn a profit. But it is far more likely for you to become a profitable trader just using a tool, using it well, and then paying them whatever they are asking for, and then using that information to go make money in the markets. Again, none of these tools are going to be worth it if you just want to paper trade, or indulge in some kind of mental masturbation and creating new strategies, just looking at numbers saying, "Oh yeah, wow, this is such a good strategy." But unless you actually go out and have the rubber meet the road and put money on it and start making money on it, all of this is just poppycock. Like, there's no point doing any of this shit. So with that said, so that's one approach, like the easy approach. The second, and which in my opinion would be the recommended approach, but also will take much longer and far more effort, is to learn the skills required yourself to be able to do this stuff, right? Many people are like, "Yeah, sir, I don't know how to backtest. uh, i I don't know how to code." I'm like, "Why don't you learn to code?" Right? So then they're like, "How do I learn to code?" Right? So today, all said and done, there's one very simple thing that is, at everyone's disposal, and that's Google. Just Google search this shit. Don't ask me how do I learn to code. Just Google how do I learn to code, or just Google learn to code, how to backtest. Google these things. Why would you go and ask, say, just me specifically? I don't know everything. I'm not, what's the word for this? Omnipresent is some omnipotent. I think is somebody who knows everything, right? So I'm not omnipotent, and from what I know, nobody is. So you're much better, and Google is probably like the closest thing that comes to it. So just use that, right? Because you'll get hundreds and thousands of different links to go to people, and again, all the problems that you're facing. Oh, omnipotent isn't it? It's omniscient. Omniscient. Right, right. Thank you, Varun. Um, Omnipresent is one that's present everywhere. What's omnipotent then? Let me Google it. Ah, you see, this is how you Google. Ah, having unlimited power. Ah, fair, fair, fair. Omniscient. Knowing everything. Yes, yes, yes. Omniscient is how you say it. I like it. I like it. Right. So I have just demonstrated right in front of you the the power of Google. I didn't know something or wasn't sure on something. I used Google, and now I know, right? So this is something that is available to each and every one of you, and if you're not using it, you're just doing a big disservice to yourself. um, so Google stuff, right? I'm not saying don't ask other people for help, do, but when you ask people for help, be respectful of their time, and make sure the questions that you are asking are very like specific targeted questions, right? If somebody has a very specific like Python bug that you're facing, right? Yeah, I was trying to do this and this is not working out. Then somebody you ask regarding Python might be happy to help you with that, right? Because you're asking something that even to them might be worth like looking into. If you just go ask and ask someone ki, teach me how to do algo trading, right? The fuck, go fuck yourself. Why don't you just Google this shit, right? Because the other people have things to do, right? And because you're asking somebody something, there's a very good probability that they know more than you, hence their time is probably worth more than yours, and you just going and pestering them with stupid questions is eventually just going to piss them off, right? Maybe they'll, again, I'm not saying any of this from a place of ego or hubris. Maybe a bit of it is, but I'm also just saying, in general, to help you guys become more independent in your own learning and your own growth, right? Because today, particularly with something like trading, I see a lot of people dependent on others to teach them things or to guide them. And I'm not saying having guides or mentors is a bad thing, but try and be more, I think the word for this is being an autodidact. Just learn yourself. And once you can do that, then you've, unlocked, the ultimate power. Because now nobody can stop your growth except you, right? Only you are in full control. You're in the driver's seat of your personal growth. And once you have that, then you're gonna, you know, you can literally do anything. So with that philosophical tangent secured, right? So what I'll do is I'll give you guys a bit of my background on how I came about doing this, how I got into quantitative trading or algorithmic trading. And just to dispel any kind of doubts, when I say the word quantitative trading, algorithmic trading, rules-based trading, mechanical trading, systematic trading, when I say it, all of it essentially just means trading where the signal generation being, whether to buy or sell, right? That part and the execution of that trade are both automated in the sense that they happen automatically. The machine does it for you. There's no human input, or you aren't going and doing the stuff, right? So whenever I use these words, I'll use them interchangeably, right? Even though there are more nuanced descriptions to each, they're by and large today, worth they're effectively synonyms today. So and that is how I'll use them, right? So how did I get started doing this? About 3.5, maybe 4 years now. I was all right. So maybe a lot of people don't know this. I am still a college student. I'm in my last semester of my undergraduate degree, which is in mathematics and computer science. So about 4 years ago, 3.5, 4 years ago, I was effectively I just stopped partying too much, right? Because the first time I was usually otherwise very homely, and wait. So Himanshu is saying he's experiencing low audio. Is that a problem everyone is facing? Himanshu, I think there's a problem on your end. Right. So um, I was otherwise a very homely, like I wouldn't, do too much. I wouldn't explore too many things. I was always a bit, interested in weird arcane shit, but I never would go out of, you know, the good kid boundaries and do stuff. Right. I was very like nice in that regard. So the first time I had the opportunity to go to college, staying in a hostel, that level of freedom was intoxicating, and I was, abusing it to the limit, right? Um, so a year or so into abusing it, I realized I was just whiling my time away, and I should probably start doing something meaningful with my life. But I honestly had no clue what to do. So that's when two people I usually turn to for advice or input. The first being, or I mean, I have many people who give me good inputs, and they're like my guides, mentors, both within my family and outside. Uh, so in this case, the two people that came to the rescue was one, my uncle, who's a professor in New York at NYU. He teaches like data-driven decision making at the Stern School of Business. So, and he had for the longest time been asking me, "Yeah, Behan, you should learn to code, and you should learn to, you should learn at least one programming language, uh, uh, because that's like the future of everything. You should learn data science, and without that, you're effectively handicapped today." So I was like, "All right, I'll just take your advice, and because I have nothing better to do, I'll start learning to program." And my cousin brother, who was at the time studying for his CFA, he was like, "Yaar, tu CFA pad, right? He didn't say CFA pad. He was like, you should look into finance and investing and trading, and there's a lot of scope in this field. There's a lot of easy money to be made, and who doesn't like easy money?" So I was like, "All right, yeah, I think that's a good thing. I'll look into that also." So I simultaneously started learning finance, trading, investing, that stuff, and learning to program or code, and learning computer science. So, and it also helped that, even though I'd gone in initially as an economics and psychology major, I'd switched to mathematics and computer science. And so everything just sat really well with me trying to study all the things and juggle them. So how did I learn? Let me tell you, college was absolutely useless. I fuck, barely attended. I have gone semesters without attending a single class. I have, and again, and that reflects on my GPA, because my GPA is absolutely shit. But that already happened within the first few semesters, so there was no salvaging it anyways. So I just realized, I can, and especially in today's information age, with the internet, you can. I'm not saying my college is bad, right? Or even in general, college is bad. But if you can learn from professors at Caltech and MIT on the internet, why would you want to, bet on some other assistant professor that's trying to teach you whatever subject? So you have the best available at you, at your fingertips. And if you have any doubts, then go take them to your professor and say, "Sir, ye samajh nahi aaya, can you help me with this?" So most of the learning that I was doing was, myself on the internet, via books, and just working on projects. So the first thing I ever built, and I remember this very clearly, was so my brother had told me about this concept called the Markowitz efficient frontier, which is like a concept within the modern portfolio theory. Essentially, if you have, a bunch of stocks that you have to invest into, and you know what kind of return they generate and what kind of standard deviation they have, standard deviation being how much the price moves around, you can structure a portfolio of such stocks based on this information, wherein you can maximize some metric going into the future. Either you can maximize your returns, minimize your risk, or you can uh, create the optimal risk to return ratio, or and risk here being the standard deviation in finance theory. So the term that most traders might be familiar with, called the Sharpe ratio. So you optimize your portfolio for the best Sharpe ratio that it can achieve given these stocks and their characteristics. So this was the project that I started working on, trying to code in Python myself for the Indian stock market. So then, of course, number one is, where do I get data? Now, this is again a question that many people ask me even today. So where can I get end of day data, intraday data, options data, continuous futures, individual futures contracts, whatever? Number one, just Google this shit, right? 99% your answer is already there. You'll probably stumble upon some free data source, but good data doesn't come for free. So you'll probably have to dish some money either individually, or if you can conspire in a way that you have 5 people who can together Dutch the cost of a data set, it's even better. So yeah, do these things. Yeah, come on, you have to be a little street smart and a little take some initiative for your learning and for your life, right? Nobody's going to hand you the secret to being successful on a platter. And Sawant is asking me, can you tell me why people lose in the market even after learning from big trainers? I don't know what big trainers you're talking about, but probably because those big trainers are garbage, number one. If not, some of them are even good. They'll give you good knowledge. But most of the training that I've seen, or the knowledge that people give, is very subjective in nature. There's input from your end required, or discretion from your end required, to be able to profit successfully off of these. One good example is, good friend slash mentor, Asit sir. His methodology is super sound. Fundamentally, the ranking system and whatnot, even the scalping webinar of his, it's very sound ideas. The problem being, his experience and skill puts him in a place that with this knowledge, when he's looking at the market, he's on his trading terminal. He can make split second decisions, trade, knows when to book, can stomach drawdowns and losses. And that's a lot of stuff that will, that essentially comes from experience and is discretionary input from his end, or is like his input, that is Asit sir being added to the trading system. Now, even if he was to tell you everything else that goes into the trading system and gives it to you, as long as you don't have that Asit element, right, the X factor, so to speak, that Asit sir has, you will be, you will just not be able to replicate the same returns, right? It's simply not possible. Yes, if you practice with time, you get better, and you attain the same level of proficiency as he has, then you'll be able to replicate those numbers. Yes, but before that will be a lot of pain and effort from your end, and most people just aren't willing to put that effort in. They just want, yeah, I just want ready-made shit, which, as far as discretionary trading is concerned, is simply not possible. So this is, one of the big, and like I said before, the most probable reason why you're not making any money even after your big trainer's training is because that trainer's garbage, right? Either what they're telling you isn't useful in the first place. If it is, they're probably not telling it well enough for you to be able to use it. And, lastly, after putting all the blame on them, there is very much the probability or possibility that you just aren't putting to use or putting to work what, they taught you. So, like, these are the possible reasons I can think of why after anybody training you, you fail to learn. And also because maybe you have, or they have sold you, bullshit expectation, right? If you're thinking attending a 2-day seminar, or even this 2-day web, like, again, I'll come to the nature of this webinar later, but as far as discretionary stuff is concerned, where your own experience and manual input is required, if you're thinking you can gain this in 2 days, or anybody can teach you this, say, fuck 2 days, even in 2 weeks or 2 months. If you're thinking this is going to happen, you're sorely mistaken, right? Maybe some specific element. Now, I know this person called Pathik, right? Pathik sir, he teaches a quarter-long hand-holding course in for earnings trading, right? For trading corporate earnings. At the end of those 3 months, will you be fairly proficient with trading earnings? Probably, right? Because that's a very niche thing that he's trying to teach. He's not giving you some magic pill. He tells you very realistic numbers to expect out of the trading that you do with it. And he has a very, solid teaching methodology wherein he's literally showing you what to do and how to do it. So something like that will probably work. But most of the other shit you learn is, or people selling you the shit, is just trash. You're not going to make any money out of it. And the reason they're probably selling you that shit is probably they don't make money out of it anyways, right? So, like, that would be my answer to your question, Sound sir. All right. Can someone remind me what I was talking about before this? This happens with me. I get lost in tangents. Yeah, my own story. Thank you. So we were on the Markowitz efficient frontier, maximizing your portfolio, the Sharpe ratio of your portfolio, given the characteristics of the stocks. So data, uh, where where do you get data from? Start Googling. You'll probably get the answer. Best bet, just buy it from a data vendor. Be smart enough to conspire in a way to split the cost in case what you're buying is very expensive. Again, not all of the information, or not all of the tips that I'm giving you will be very white, in the sense, like, they'll not be very I mean, for lack of a better word, ethical. But a lot of money is made in the gray areas. So if you're okay with it, I suggest you explore those. Now, where did I get my data from? I just, there's a website called Quandl, QUANDL. They offer data sets, some free, some paid. Fortunately, the National Stock Exchange end of day data set was free. So I figured out, how do I use Python to fetch this data set? How did I do this? I didn't go around asking people, how do I get data in Python from Quandl? I simply looked at the documentation Quandl had. They literally, like these days, people have like very nice documentations. They'll literally put the code there that you have to copy paste into your program to be able to do something. I just copied it, pasted it, just read through the lines. What exactly is this trying to do? Got an idea. Yes, this is probably what it's doing. Got the data, right? Now, when I started working with it for the first time, I realized there's something called stock splits, because in the data, when I plotted it, I saw the graph going, in one direction. Suddenly there would be a big gap, and then it would continue going, and then there would be another gap and keep going. And it became pretty evident that this doesn't seem like normal overnight moves where it's moving 100, 200, 300%, right? So that's when I started reading up on stock splits. So first I looked at why is this thing happening. So I compared that chart with the Google पे जो share का chart आता है. I just compared the two charts, and I saw that the Google one looks very different from the one I have, and the difference specifically being those big jumps. So I started looking into what those jumps are. There were stock splits. Then I learned how do these work, why do they happen, and how can I. And then I just thought about how can I fix this in my data. So I just thought maybe I should write a program that rolls over the entire data frame of the price series, and wherever it finds like a gap that exceeds this much. All right, for say like the past 52 days, this is how much. For the past 52 weeks, this was like the average uh, change in magnitude. This was the standard deviation, and if something is like a 10 standard deviation move overnight, this is probably a stock spread, right? So adjust that, like take that multiple and then adjust it, right? So that's how I adjusted my data. Then then I just read about the theory, coded it up, and that was my first project. Took me, I think, like a month, 1.5 months to do all of this. Simultaneously, somebody I know needed help with a Python. They wanted an intern who could do machine learning and data science and Python, right? I honestly didn't know either of those things at the time. I just started learning Python and data science and everything. But I just walked out to them and said, I know the shit. I can do it. So they were like, "Acha, how much will you charge?" I was like, I won't charge you. I'll be happy. This is too easy to charge for. So I just said I'll work for free, and said that I can do whatever they wanted me to. And my objective here being, I'll just work and learn on the job, right? So like get hands-on experience using whatever techniques or whatever they want me to do. So hands-on, I sort of built, and of course with advice or guidance from another, like an actual data scientist at that firm. He guided me through it, and then I realized how do you set up databases, how do you run. Like I specifically remember I had to study up on principal component analysis, factor analysis, other clustering algorithms, create like a framework where the user can input what algorithm they would like to use, how many clusters they're trying to create, so on. So all of that I learned on the job, working the next 4 to 6 months for free. So again, a lot of people are like, how can I learn this stuff, right? Just go. I mean, if you don't want to pay to learn, and you also don't want to put any effort to learn, then you probably aren't going to learn, right? You're just fucked. However, if you're okay to pay, just pay and join like a proper course, or like get like a teacher to help you. If not, just be willing to put in the effort on your end. Go sign up for a project, or just pick a project on your own. Go to Kaggle. There's a lot of data science competitions happening. There's many such websites with whatever you're trying to learn. And say if you just want to learn about, say, equity research, right? Go to some, maybe not a big mutual fund house or an actual asset management firm, but go to somebody is into trading or investing, or like analyzes companies, and be like, so I can I'll give you good, like very solid, comprehensive equity research reports every week or every month, and I just want you to give me your feedback on it, right? And uh, maybe that's a good way. And if this person says okay, you just have on your hands like a mentor who's essentially guiding you for free. So and that's a powerful thing. So Yeah, that's one way to learn. Right. So once I'd coded up this Markowitz efficient frontier thing, then the Python thing happened. That's when I gathered like a bunch of people in college, like a bunch of juniors and my own batchmates, saying, let's start like a blog. We'll give it some fancy name and we'll write down or like we'll write posts about quant trading, analyze companies, and we'll do it in very data sciencey way, data driven way. So Black Rose, my firm today, essentially started as a blog. Right. Just give me 1 second, guys. Let me just mute this. Right. So that's how my firm started. It was essentially a blog, which was with 5, 6 other people. And then, very instantly, whenever I pick up projects, I suddenly like start envisioning, how can I take this big, like 10x, 100x, 1000x, or what it is today. So like, fuck this blog. Let's just turn this into an actual trading company. So then I pitched the ideas to everyone and told them, whatever I was expecting of you guys right now, 100x that also, because if you want to make something grow 100x, you'll have to put in that much more effort also. So most of them dropped out. One of them stuck around, who's currently my partner at the firm. And then we had like a whole journey. We first started working with the American markets. First, we picked up US equities and US options data. That's what we were working with. Then we switched to, we actually went to the States, got like a Harvard student as a partner. Then we went on to, uh, you know, um, raise like a bit of money, learned all about how the hedge fund industry works, how funds are structured, what are the legalities of it, what are the, different entities that are involved in raising a fund. So once that was done, we realized, this just isn't feasible from a, a financials and legalities perspective right now. Being two Indians trying to raise a fund in the States probably won't work. Then we thought, maybe currencies, explored that a bit. Then we came to India, and then we had already starting at this, like, 1.5 years ago, where we started researching Indian markets. And then we realized, yeah, you know, um, this is probably what we want to do, just trade the Indian markets, because it's ripe with alpha, like low hanging alpha. Meaning, like, you can, I mean, a lot of people, I don't know, maybe you know this or don't, the Indian markets compared to something like the States are very inefficient. You can make a lot of easy money that you can here than you can in the States, right? So yeah, so, and here we are. So then I started, connecting with people, you know uh, doing these free webinars to, because I realized there's a lot of garbage knowledge as far as trading is concerned. uh, However, there's very little, like, at least as far as quantitative or systematic trading is concerned, I personally did not see any quality material. So I thought, like, this is a vacuum that I can fill myself, probably in the process connect with a couple of people, in the process learn myself also. And here we are. Right. So number one is, all right, so we have some comments. Right. Um, all right. Um, I won't be so rude as to kick HP out, but I mean, I'll be happy to. And again, I think this is also a problem with people, particularly in India, as far as, and particularly people who want to become traders or make money in the markets. There's a, blatant lack of humility or, concern for other people or whatever, right? So, I mean, fuck him. Like, I don't give two shits about it. Actually, I'll go so far as to kick him off. Fuck him. All right. So somebody's asking me, what is the timeline of your journey from US market to India? So all of these questions are very interesting, and I'd be happy to answer them. All right, I'll just answer them. So what is the timeline? And also, when I say 11 to 2, you should probably have like 11 to 3 or 11 to 4 is the runtime of the webinar. So if anybody's, busy or something else, feel free to go, you know, do your own thing, and you can always watch the recording. Right? There's no bound, but I almost always overshoot the timings of whatever I'm planning to do, and especially when I have nothing planned afterwards. So, right. So the timeline of the journey from US to India, right? So I'll tell you why we started with the US in the first place, right? In the US, so at least when we had started, data in India wasn't, or at least with the amount of effort that we had put into researching and searching for data, there wasn't too much of it. There weren't too many like technology enabled brokers with like APIs and all this stuff. So we just thought that, and US of course has, so many quant firms trading there already that, even a lot of you probably also know of. And Renaissance Technologies was like one of my main, what do you say, inspirations in becoming quantitative or systematic in my trading. So I was like, let's go do US markets, and data there for the US markets is also very easily available. So that's why we started in the States, and we created the first model we created, and that was like the crux of our US trading system, was something that simultaneously traded correlations and volatility. Correlation being it would trade the S&P 500 constituents, and particularly the ones that had liquid option chains, and see correlations among the different constituents and how those behave. And whenever there was a deviation on it, that is what we would like to take a bet on. However, that alone we realized wasn't a sufficient edge. So what we did was we layered that with another edge, which was like a volatility edge. So if you guys are familiar with how volatility behaves, particularly the cyclic nature, is that when volatility is very low, it has a it'll probably go up eventually, and if it's very high, it'll probably go low. So with this kind of framework, we started analyzing a bit of options data and vol data, and there they have like very nice volatility trading instruments also that we could analyze data for. So um, that's when we realized, and we were able to create like a micro edge there also, like in terms of volatility trading via options and the correlation direction that we would take on the underlying stock themselves. So then we combine both of these, right? So if, for example, we think X is going to go up, Y is going to go down, and in terms of the relative volatility, X has a lower volatility and Y has a higher volatility, and so we would expect both of these things to converge, or something or the other to give us money doing this. So we'd buy X, sell Y. The way we would buy X is, say, we would buy a call option, and we would sell Y by, say, selling a call option or selling a call spread. And we had like proper like a framework for where do we want to structure the spread, how. So that was the way we were planning to trade the US market, and it was making, I mean, pretty decent money by at least the standards we had back then. And it was definitely positive expectancy, so we were very happy. But when we started pitching it around in the States, with whatever network I had, and then with the partner we had taken on over there, with the kind of network he had, uh, it became evident that you know having a good strategy is the least of your concerns when you're trying to be something like a fund manager, right? This is really, and a lot of people think otherwise. They think, yeah, if I have a good strategy, then I'm sorted. I'll become a fund manager. I'll become the next, George Soros or Renaissance or what, Warren Buffett or Ray Dalio. But that's honestly not the case. This trading itself is like, has a lot of moving parts that you have to get right. Even if you get that right, the it's far more complex to actually build a profitable fund management business around it, right? They are both in and of themselves non-trivial tasks. um, Fund management, I would say, I would wager being the even harder one. So yeah, so we realized, yeah, US may, it's the amount of effort that will involve, the amount of time it will take, and the amount of capital it will require just to get things up and running. Or then we also considered something like Singapore as the base of operations. Even that had a very, and we spoke to somebody who was a fund manager there. He said, yeah, if you have less than $50 million, don't even bother. So we were like, yeah, 50 million to nahi hai. So we we realized, fuck Singapore, fuck US, let's just come back home and target this. Fortunately, by the time we came back home, brokers had APIs, data was more easily available. And, we were just like, now maybe this is possible. So once that began, once that was the case, that's when we started doing Indian markets. So I hope that covers your AG who's asked me, my timeline, and in terms of the time. So say 2.5 years, 2018. So 18 to 19, 19, 20. So 1.5 years ago is essentially when we started working on the Indian markets, and before that we were doing US markets. So yeah. So Raghav is asking, what's your thought on mechanical versus discretionary trading? I think I'm not saying discretionary trading doesn't work. It most definitely does, but it's rare to find the kind of caliber / skill required to be a successful discretionary trader, and it's also far more painful in my opinion. Right? It's just not worth it. Discretionary traders will, and I think data backs this also, that they die, much earlier than the average like human does, simply because the amount of stress involved being a discretionary trader is insane. I'll tell you an example, right? A friend of mine is was trading a systematic strategy, and one of the criteria in that strategy was, once you open the position, you just hold it towards the end of the day, right? You don't square it off in the middle of the day. He started to experiment with trying to book profits in the middle of the day when they become sizable, right? He tried doing this for 2 weeks. Over the course of those 2 weeks, the amount of emotional strain and the amount of emotional pressure and the roller coaster he went through, I am, first hand witness to it. And he would, bounce thoughts to me, yeah, bhai book kare na kare, yaar main sahi kar raha hu, so on. And it is painful, right? It's not easy to, trade discretionarily. So um, so that's one thing. So it's a lot of unnecessary emotional pain that you have to bear. Secondly, there are limitations to discretionary trading, in that there's only so much you can do with it, right? Maybe you can trade 1 or 2, 5, 10 different instruments alone. If you have a team, then it's a different story. But alone, you probably do like 2 or 3, 4 things, right? And you have to be there in front of the system. If you're trading 9 to 3, you've got to be there. That's like 6 hours of your day taken away, right? So I think there's no point doing this, especially today, when the machine can do the execution for you, do it much better than you can, and it frees up your time to do something else, right? You can supervise it and just chill, research, build new strategies, learn new stuff. So why would you want to pick discretionary over systematic, assuming you have whatever skills and knowledge is required to be a systematic trader? If you don't, I mean, then you have no option, right? Then you probably have to learn uh, uh, the skills required, or the knowledge, or the tools to be able to trade in a systematic manner. If you have that, then I see absolutely no reason to pick discretionary. Also, for example, this is when we started trading India, our execution engine wasn't set up, and the first thing we decided to start trading was crude oil, right? Crude oil future. Now the system, and again, something about myself, I am a very bad. Like, I'm an abysmal discretionary trader, and I could probably never make a good discretionary trader, simply because uh, my personality is very much inclined towards being a compulsive gambler. I like gambling. I like thrill, right? And if you like thrill, systematic trading will also be painful, in the sense you itch to do something, but you're just not allowed to. Or you're not supposed to, right? In discretionary trading, there's that action, there's that thrill, that something is happening, right? It's like an action movie, or like a thriller. So you feel like you're doing something. In systematic trading, that's not really the case, right? So so when we built this crude oil system, so the system, in terms of the signal generation, was quantitative, or was systematic, that the data would come in, it would process, and it would spit out a buy or a sell, right? And this was essentially trying to trade when in the evening, the US mercantile exchange opens up, and it would essentially try to play the spike up or down, or nothing that might happen as a result when that happens, around 6:30 or whatever, 5:30, 6:30. So once the system was ready, our execution engine till that point wasn't, like, the thing that was supposed to send trades automatically, that wasn't ready yet. So what we decided was, I'll just have the system spit out the trade, and I'll place the order manually. And we were just prototyping, testing things out. It was small capital, you know maybe by most standards, but by some people's standards that might be sizable capital that we were working with. So it spit out the trade, and for example it said, buy one lot of crude oil futures. I went for, I was like, I'm confident in this system, I'll buy 5 lots. So that rule 2 that we had talked about, I already fucked it up. So I bought a much larger quantity, hence taking on much more risk than the system had advised. So I fucked up, and I paid for it daily in that very first trade itself, because we went long, it went up, and again I fucked up twice. The system then said, so I fucked up point number 3 also. So we had created a profitable, like a positive expectancy system. I fucked up the execution in that I took too much risk. Then I fucked up in number 3, in terms of the execution, that there was a target, ki bhai itna profit ho jaye to just book it and leave. We hit that target, but that target wasn't like in the system. I knew ki, once we make this much money, just book the profits and leave. We hit the profit target, and I just stood there. I was like, abhi bhai aur jayega. My partner was like, bro, just book it, paisa aa raha hai, chalte hain, ho gaya ye wo. I was like, nahi nahi bhai, ye bahut aayega, baithe rehte hain. And it kept increasing. We made 2x the profit we were supposed to, 3x the profit we were supposed to. I was like, bhai 5x पे book कर लेंगे. So वो 5x कभी छुआ ही नहीं. Suddenly it just turned around, and it just went the other way, blew away the stop loss, and the stop loss was fortunately in the system. Hence, a good portion of my capital was wiped out. But if I didn't have a stop loss, probably the entire thing would be wiped out, and maybe I'd even end up owing money to my broker, because that was a very, very sharp move. And there was some historical event, maybe it was like the dollar, the USD INR hitting 70 or something. I forget why this had happened. I'm not 100% sure anymore. But I remember I did some like hindsight analysis कि यार अरे यार ये हुआ इसलिए हमारा loss हुआ वरना हमारा profit हो जाता. But honestly, I was the one at fault at not following the system properly. So hence I don't do any discretionary trading anymore, and I would not advise anyone who has the caliber and the skill set for it to do so either. So let's see. So I hope that answers your discretionary versus systematic question. Then for some people, what do you think about high frequency trading in India having AWS features? I am not sure what you mean. AWS features kya? So all right, I think that addresses all the questions that I have so far. Pavan has asked, as you know, India VIX is 80 before a couple of weeks. So the thing with, I think the simplest thing one should do and implement is have a dynamic position sizing system. So if, for example, the spike in VIX, for example, if you're trading options, if you were buying something and having a 10% stop loss, right? So earlier the contract was 100 rupees, and you had a 10 rupees stop loss into the lot size. Say if it's Bank Nifty, you had a 200 point risk. Now on that same per lot, if it's 1,000 rupees because of the spike VIX, you have a 2,000 rupee risk, right? So what is the simplest way to adjust for this, right? For example, you're looking to trade, say if you're looking to risk say 10,000 rupees on every trade, or say 1,000 rupees on every trade. So in the initial condition where it was 200 rupees risk per lot, you would trade 5 lots. And in the case where it's 2,000 rupees per lot and your maximum risk is 1,000 rupees per trade, you don't take a single lot. You just don't trade, right? And that's at least how we have chosen to structure things, so as to make sure that there's no uncertainty with how much risk I have in a trade. The maximum risk is capped. It might be the case that the system doesn't take any trades simply because the risk per lot exceeds the maximum risk even in a single trade. But that ensures that we at any given point in time are assured of how much risk is there in any single trade, right? The maximum we already know. The minimum could be something else. Maybe it was able to buy say 2 lots, where if I have 5,000 rupee risk, and with 2,000 rupees per lot, it bought for 2 lots, so 4,000 rupees at risk, maximum being 5,000. So I know I'm never going to lose, say, way more than 5,000. Maybe after slippages or something, I might lose 5,020 or 5,050, but I'll never lose like 8,000, right? So yeah. Whew. Mm, Pratap sir is saying, in high volatility, my stop loss skips sometimes. How's your experience in automation in terms of percentage of time this happens? So we always track what is the slippage that we have assumed in our back tests and in the models, and how much we're experiencing. For some reason, a lot of people were telling me, "Yeah, in this high VIX time, there are certain times where the bid ask might be a tad bit wider than you'd expect, and with freezes and all, it's a different story." But by and large, I did not see too much of a difference between, in the stop losses and all. Maybe that's because of the way we select contracts accounts for this. But I personally did not see too much of a difference between, pre high VIX and post high VIX in terms of, the stop loss. Again, the stop loss being skipped is a very dangerous thing, particularly for somebody, say, who's selling options, right? If your stop loss is skipped, you are in line to be majorly fucked. So it's a dangerous thing. So it's stuff you should look into. But at least, fortunately, we haven't had any bad experiences with it yet. So yeah, we haven't had any stop loss skips, so to speak. A slippage here and there, of course, is allowed, but that's within the model. But we haven't had any instance of a stop loss skip. I know somebody who had such an experience, but that is because they had effectively held a trade into circuit, which I think is stupid, right? Why would you? And then you, of course, can't cut your position because the option is in circuit; it's not trading anymore. And that also was like some freak case that had happened. But apart from that, the stop slip, I haven't experienced, or we haven't experienced personally, right? So, right. All right. So what I'll do is, now let's get into the content of today's webinar. So I'm sure there's a lot of people here who like, expiries, right? Expiries are very action-packed days, and there's a whole hype around, doing expiry trading, whether that be on the buy or the sell side. And expiries honestly are exciting times, right? The Greeks say the gamma is at its peak. Out of the money options are tending to zero very quickly. In the money options, the slightest move, will, rattle your PNL. So it's an exciting day, right? The Thursdays. And the first strategy that we ever built for the Indian markets was a nifty expiry option buying strategy, right? The first model that we had built for the Indian markets was supposed to be that we actually traded it on up stocks via their API. Sorry. And the single day we traded it, we made 6% on the portfolio. But the way the strategy was, and we were very happy, because 6% in a day is like pretty solid. And the return but unfortunately, then we had like problems with Upstock's API and this, that, and the other thing. And then we started looking for new brokers, started building new strategies, whatnot. And the kernel of that strategy has essentially remained the same, but we had made some modifications to it, traded it later, but now we no longer use it. And that is the thing I'll be sharing with you guys tomorrow, which, I hope will be of interest to everyone. But one change is, instead of Nifty, we will be working with Bank Nifty, because Nifty options, again, for demonstration purposes, does not have enough data for what I'm looking to demonstrate to you guys. So we'll just work with Bank Nifty instead. And even today, we'll work with Bank Nifty. So essentially, by the end of these 2 days, you will have, say, two individual strategies that I would suggest you trade in combination on expiry days. And, you know, you would effectively be a Bank Nifty expiry trader, both long and short, which is, rare to see in today's days, where everybody is picking sides for some reason. So I think that would be of good use to everyone, right? So first off, so let's get started. Now, over the course of this webinar, I'll keep introducing certain tools and certain, certain platforms that I would suggest you guys use. Again, that suggestion is not something that you necessarily have to abide by. It's only a suggestion. It's not like an order. So you can if you find the platform helpful, use it. If you don't, just fuck it. And I'll try to be as transparent and honest with the pros and cons of the platform and my vested interests wherever relevant in such a platform, right? So what I'm going to do, first I'll give you guys the theory behind this, right? And I won't go too much into the theory. I hope you guys can now see my screen. um, the theory is essentially for you guys to have a conceptual understanding of what we are doing and why we are doing it, right? So what we're going to be working with in terms of the instrument is the bank nifty index, which is an index of as the name suggests, banks uh, and like financial services companies. So we'll work with bank nifty, right? um, this is like the underline or the underline. We'll be trading the instrument that we'll be trading are going to be options, and we'll almost all like fuck almost always we'll always be trading the current or the front expiry contract, right? This means when there's a weekly contract running, we trade the weekly, and when the closest contract to expiry is a monthly, that's the one we trade, right? Which is towards the end of the month. The days we're going to trade this is on Thursday or expiry in the situations where Thursday is an off day. The way we'll test it right now is only going to be for Thursdays. So we know we're trading it on the Thursday expiries. Now there might be cases when the Wednesday is an expiry, which is again a rare scenario, but that won't be incorporated in the way we are testing it. But I think that shouldn't be too much of an issue, right? Now our paradigm is simple, like what is the view we are taking when building the strategy, right? This one is for option selling. The idea is we're doing option selling. Specifically, we're selling straddles. For those of you who do not know what a straddle is, it is an at the money call plus an at the money put, or essentially a call and a put of the same strike. So the at the money straddle is what we'll be trading, which is the at the money call and the at the money put. The straddle is any call and put combined of the same strike, right? This is the instrument we'll be trading, the at the money straddle. So for example, bank nifty is at 31,120. We round it down to the nearest hundreds, which is what so this is the spot. We round it to the nearest hundreds, which is the denomination in which you get strike prices on bank nifty contracts. So we'll round this to 31,100, right? So we'll take the 31,100 call and the 31,100 put, and we'll sell this. We'll look to sell both of them, right? Now this is essentially the idea. Why are we doing this on expiries? Why? Right? Because expiries is when your theta decay, which is the option losing value in terms of time, is going to be at its peak, right? It's going to be at its peak, so it's always I mean, for any given day, say Monday, Tuesday, Wednesday, Thursday, Friday, Thursday is going to be the day where theta decays at its peak, right? So that's that. That's one of the reasons we're doing this. The another reason is, and any out of the money option on expiry goes to zero, right? Or actually, it just goes to zero by the end of the day. But we usually won't, or we don't have to. We can things to the end of the day, we can square it off at like 3:20, like 3:20, 3:15 p.m., whatever, right? So that's one of the reasons. So like theta decay is at its peak. Number two is this concept of options more often than not being overpriced, right? Or option. So option are overpriced. The idea being, this is very much like insurance, right? The uncertainty that they have is overpriced, or the uncertainty that their forecasting is overpriced. The idea of this is that implied volatility, which is essentially the driving factor of option prices, is almost always higher than the realized volatility. So this is what the option contract is saying will be the volatility of the instrument, and this is what we actually see in the future, or like when we get there. So this almost always is greater than this, right? And you can see this if you plot a graph of IV minus RV. This will always have like almost always be greater than zero. There'll be rare cases when it's the other way around, which some people will tell you is not a good time to sell options, and that is also fair. Like there's reasoning, like or there's logic behind that also. But by and large, IV is almost always greater than RV. So I again, for those who don't know, IV is implied volatility, RV is realized volatility. Hence, because like options are overpriced, and if they weren't, then nobody would be selling them, right? Nobody would want to sell something cheaper than what it would be realized for, because then they know it's a losing game. They wouldn't want to sell it at that price, because then they aren't being compensated for whatever risk they're taking. So like insurance companies will always almost like that's the reason insurance companies, like one of the reasons they make money is because one, they diversify the risk, which is a good thing to do. Second being that they sell things higher than in terms of expectancy, what they will be expected to pay on average, right? So these are essentially the two underlying principles behind what we want to do. And number three being that and this is like again one of the principles Akash sir had shared last time, and is like a very foundational thing to his thinking, is that if you have a stop loss, right? Guys, somebody is using the annotate thing, please don't. So if you have a stop loss on your thing, right? And again, this is like a very old idea, right? Cut your losers fast, let the winners run, right? Essentially, it means when you're losing money on a trade, just cut it. Have like a tight stop loss, tight risk, and let winners run means basically when money is coming your way, just let it come. Like देने वाला जब भी देता देता छप्पड़ फाड़ दो. That is the principle behind all of this, right? So essentially, these are the three things that we are going to, or these are like the concepts behind why we are, or the way we are building our strategy, right? Or we're going to work with our strategy, right? So now we come to the strategy building part, which we will do with a platform called StockMock. StockMock, right? Now I will be straight up with you guys. I'll tell you how I found out about this platform. Like, what's the story behind it? A couple of months ago, a friend of mine, actually two friends of mine, came up to me with something that built on this platform, like a strategy saying, "Yeah, yeah, this is making so much money. Let's trade this. Let's automate this. Let's trade this." I was like, "Bro, what is this garbage platform? This thing? It's not that easy to make money." And it was a super simple strategy. It was essentially just selling strategies. Like it's not that easy to make money in the markets. And they were like, "नहीं नहीं यार, they we tested it 9:15 पे entry लेंगे ये." मैंने कहा भाई 9:15 you can never. All right, just give me a second, guys. Ganpat ji, can you please turn off your video? Just give me a second. I'll put myself. Done. Manchu, it's good. Right. So I essentially like discarded, the numbers you had shown. I was like, and particularly because at least the way they tested it then, there was a like a conceptual flaw in it that they were taking 915, the opening price of the market as entry. I was like, bro, that's you can never get filled at that price, right? The price that you see in the data there is it's effectively like it's like a coast. You'll never get filled there. So this strategy doesn't work. So they went back, made some changes to it, revised the entry time to a realistic time, and came back and said, "Hey, bro, look at this, it's still making money." Then I went through the trade log and I was like, "Bro, this is not accounting for slippages, cost, jumps, all of this shit. The strat." He's like, "Bro, no, you test this logic in Python. You use your own back testing and see if it makes money, and then we'll do it. You don't believe this?" I was like, "Okay." And plus, it was only 1 year, so I was like, fuck this is nonsense. So I like, oh, acha, just for your satisfaction, I'll backtest this and I'll show you that this is trash. But unfortunately, when I don't I don't know if I can convey the surprise that I had when I backtested that myself, because it was so remarkably simple that it shouldn't make money. Now understand that for the past almost 3.5 years, the way we had been doing research and backtesting and everything, we were using the most like sophisticated of tools like statistical techniques, the mining data, finding features, creating synthetic indicators, this that drama. And then here comes a guy who's like, yeah, it was straddle based, this stop loss laga, then you'll make money. I was like, yeah, it's not gonna work. But when I back tested it, I was like, fuck this, this makes money. So, and I was shocked. And believe me, like I did not, I wasn't willing to buy my own back test. I was like, this is nonsense. This doesn't work. I have done some fuck up. I do not believe this. So I went to another person, मेरे परिचित हैं, and he's a very good, like again, friend slash mentor. And I was like, so I do all my work in Python. He does it in Amy Broker. So I was like, sir, could you, I'll give you the strategy logic. Can you just run the numbers on this and tell me whether it makes money? Because I am seeing it make money post slippage, post cost, post everything. And the numbers are too good to be true, in my opinion. So can you just run this and, as like a double check and let me know? So he's like, sure. So I gave him the strategy logic, again, very simple thing. So he just backtests it in one day and comes back and says, yeah, Andy, this is profitable. And it has very solid numbers. And like, we just flipped. I shit you not. And me meeting this person who told me about this was like chance, like a friend introduced a friend, that kind of. So uh, I just my thought process, like my paradigm of looking at how money can be made in the market, completely shifted. I was shocked. Then we went ahead, automated it, started trading it. I've been trading it for the past couple of months, and it's been making money every fucking month. And like part of me is like still in disbelief. I mean, it's no longer in disbelief because now the data has backed it and the live numbers have backed it. But you could say that I'm still reeling from that shock, right? And all of that started from this very platform. So that's when I started taking this platform seriously. And the beauty, or the the good or the bad, depending on whose perspective you're looking at it from. I started, exploring the platform. It was an entirely free platform, very easy to use. And I was like, yeah, this is great. I'm able to prototype strategies very quickly. Then I can take it into my own, like import the files into Python, modify them, refine them, make sure, the numbers are legit. And then I can trade it. And suddenly this thing became like an integral part of our prototyping stage. And I also started recommending this platform to other people. Plus, primarily because it was free and it was so much fun and so addictive. So I would recommend it to someone, and so for example, I recommended it to a friend, and I recommended it at like say 8 or 9 in the evening, right? Next day morning, I wake up, I get a call from him. His voice all groggy and all. He's like, वो गालियां दे रहा हूँ, क्या ठीक है, तूने मेरी रात काली कर दी है, क्या लिखा दिया तूने मुझे? And he was up all night tinkering with this platform, testing strategies. And believe me when I tell you, this is addictive, right? Or at least it was when it was free. Now there's a limitation on how many backtests you can run before you have to pay for it. So he's like, this is too good. And So and like Twitter pay, everybody is really smart, right? So people are telling me, this much data is not sufficient, there's no slippage, this, that. I know that shit, man. Come on. And you should know how to account for those, adjust for those, and make something work. um, yes, part of it is the platform's limitation, but if you know how to work with things and make them work, you'll do it. Don't look for resources, be resourceful. And I today know people who trade from single digit lakhs to double digit lakhs, upwards of 1 crore, on strategies that have been built and prototyped on this platform. All right. So now, why am I telling you all of this? Because very recently I joined the team that is behind this platform. So this was free for the longest time, and largely because of the person who was created this and the team behind it. They're such nice people that they never wanted to. I mean, not that they never wanted to charge, but they were happy to let this be used for free. And even though the costs have been growing, and it is currently a very sizable cost on that person who has built it and supporting this out of their own pocket, and primarily they were doing it through donations for the longest time. But and even though there are a few good souls out there who will donate to somebody doing like a noble thing, most people are just assholes who would rather just abuse and try to do it for as much as they can, which is the fact, right? So, and especially with this corona thing started, financials are of course becoming like challenges for almost everyone. So this nice person, the founder, calls me up, and like, I call him up. I think actually I forget. Like we get on a call, and we're like, he tells me what the situation is. I'm like, sir, maybe we can do this, that, and the other thing, and probably make a profit out of this, because I really think this platform is amazing. It can, even in its current form, with the simplicity and the UI and the potential power it holds, like, is insane. So with the correct kind of like business model around it and adding new features to it, making it even more robust and adding like capabilities of like automated execution and a couple of very fancy ideas I had. I was like, sir, let's do this. And he was like very, you know, he liked what I had to suggest, and our visions aligned. And I think because he also, of course, he being a technical person, and I also having some kind of technical literacy, he was very okay with me, joining the team to help out with both the tech and as much of the business as I possibly can. So hence, very recently I joined the platform. So one of the things that is the most obvious change to the platform in that time has been that instead of being a free thing that runs on donation, it is now a paid platform wherein you now have like 3 free credits every day, but beyond that you have to buy credits, right? But the credits are also pretty reasonable if you understand the power of this. So here's another thing: there are many apps out there, right? Even as far as options trading is concerned, there's many apps out there which you could use to augment your options trading. However, most of them are analytics tools, right? Maybe they give you some additional piece of information to maybe you're making say 10%, their information added on can make you 12%, right? For example, hypothetically, some number out there. The thing with this platform is it can take you from making zero and even losing money to making 20, 30, 50%, right? And again, I am not saying this shit as nonsense. I'm like, I have I've witnessed this. I have been on the, like, I have seen this happen, right? So, uh, Maheshwari, Mahesh, just, I see your question. I'll answer it in due time. Have patience. So, uh, that is essentially the story of StockMock. Now, what exactly is this? To answer Mahesh's question, is this an execution software? No, it is not. At least not yet, right? What is this right now? As you can see on your left, on the left of the screen, it names a bunch of spreads that you can have, the different kind of option spreads. And then there's the custom option where you can design your own kind of spread with as many legs as you'd like, whether they be futures, options, buying, selling, whatever, right? You can create a custom spread and very fancy uh, you know, some structure that you like, can test with a few very simple parameters, input parameters being time, targets, and stop loss, right? So it's very like when someone looks at this, and especially when I even looked at it, I was like, fuck this. This something this simple can't really make money. But believe me, I have been proven wrong in a fantastic manner. So I'm all for this today, and I think anybody who's looking to trade options, uh, you have to check this out, right? So now, of course, you will all have questions like, what all can it do? Can it do this? Can it do that? You know, let's see. Bharat is asking, how did this compare with Sensible? Uh, there's certain information, maybe I don't think I'm in a position to disclose it. That's entirely up to the founder if they want to discuss it. But uh, I would say this is better than what Sensible is. From the limited experience I have with Sensible, uh, it's more analytics than it is, something like this. So what is this? Like, what is the power of StockMock? What is? Why am I so fascinated by this? Because backtesting, prototyping ideas is like a very simple way in which you can find methods that make money. What is the challenge with most people that are trying to make money in the market? They don't know what works. This platform can tell you what works and do it in a very, very simple way. So I think that, so the value of anything, particularly with things like this, is, I mean, how quickly can you go from some using that platform to monetizing whatever information or knowledge you got out, right? How can you do this? That is, I think, a very good metric for the things in the trading industry, right? So, for example, a trainer or a webinar or a seminar, when you did that, from that to going from that to making money in the markets, how quick or how streamlined or how instant is that process, right? That would, at least in my opinion, dictate the value of any such tool or platform, right? So for a platform like this, that number, so whatever that number, that ratio, that metric, that going from using this to making money based on the information that you get out of this is very, very high. And I will go so far as to say it is higher than any other platform in the Indian market today. All right, I will say that right in front of you, and in the next half an hour, 1 hour, I am going to demonstrate that. All right. So that I at least in my experience and knowledge, do not see any platform that is even close to the amount of value this can deliver. All right. Now, with let's bring this talk to an end, and I'll actually now demonstrate what it can do, right? And along the way, I'll also highlight features and limitations of the platform so far, right? So what were we trying to do? We were trying to build a strategy that on expiries sells straddles. Our framework being, the reason we are doing this, and this being a very important part of the framework, that we should have a tight stop loss in place, and we'll let the winners run, which in my uh, like thinking translates to, let's not have a target, right? We'll keep the profits run, right? So how are we going to implement this here? The first thing you'll see here is you will have a from date and a to date. All right. This is essentially the data you want. All right. So first, of course, we have chosen short straddle, which is the thing that we want to trade. So it automatically says that, and it by default, sets it up as a sell. You can just click on this to switch this to a buy. That I want to now buy the put and buy the call. On, you can just click it again. So now you're selling the call in the put. So selling the straddle. If you do strangle, which is not the same strike, but a couple strikes apart, you're selling out of the money calls and puts. That is what is called a strangle, but in this case, we're working with a straddle. But feel free to experiment with these things. So short straddle, short strangle, by default sets them up as, here it's at the money call and put being sold. Long straddle will by default set it up as the at the money call and put being bought. Long strangle is going to be out of the money calls and puts being bought. You can change how many strikes away. Now I've gone into the money with calls. The same I can do with puts also. And so now this is what is called an inverted strangle. So these are all just fancy words. One of my friends trades inverted strangles and is making good money out of it. If you follow me on Twitter, you might have seen his post, which I retweeted. So, and even that was built on this platform. So now what is, so now we have the short strategy. So now comes, the date selection. Unfortunately, the data that we have right now goes all the way back only to 2019, right? From to February 15, 2019. So it's about in a year's worth of data. Now, is that a sufficient sample size to create or test strategies very comprehensively? Not really. Now, is this the platform trying to fuck you? It is not. Unfortunately, like I said, this platform was free for the longest time. Adding data, essentially increases the costs borne by the founder, right? Given this is somebody who was running it in losses for the longest time, adding more data just wasn't financially feasible, at least so far. We will now, now that it's a for-profit, so it has gone from being just a platform to an actual business that we're trying to build around it. This data will extend to, since the inception of Bank Nifty weekly options, and maybe even go all the way back to all the options when the data makes itself available. So this of course will increase. Right now we have just the past 1 year worth data to play with, but let's see what we can do with that right now. And if you have any problems, you can take it up with myself, or actually, I'm a good enough point of contact today that if you have any issues with StockMock, just feel free to ping me, right? And I'll help you out in whatever way I can. Any suggestions you have about, what should be added, or, your thoughts on the platform, leave it here on the feedback. And if there's anybody out there who has made money with this platform, please definitely let us know, because your inputs, both motivate us, drive us, and it makes a good marketing material, right? Because many people with a new platform, they would want to know whether this thing works. I know it works, but again, you can always say that my thoughts on this are biased, because not that I'm part of the team. So if you're someone who has used this platform successfully, please do give us your inputs and your feedback, and that would be really helpful, right? So now what we're going to do, just to get started, is we're not going to test what we're going to build on the entire data set, right? We're going to split this data set essentially in half. So we'll go from, or even smaller. So from February 2019, I'll not go all the way to 2020. I'll just go till August of 2019. So the 15th of February to the 25th of August 2019 is what a training data or the in sample is. I'll explain this concept also to you guys. For example, this is the data set that you're working with. Like, this is the entirety, right? This is, say, so in our case, Feb 2019 all the way to April 2020. Now, if you were to make a strategy on this entire data set, right? Say you test some idea, it doesn't work. Then the obvious thing is you'll make some changes to that idea, and then you'll test it on this entire thing. And maybe it works, maybe it doesn't. You make some changes, you keep doing this until you get something that works on this, right? And you're very happy. What do you think is the problem with this? What's the problem with this? If I use the entire data set, I create a strategy on it, it doesn't work, I keep tinkering it until it works. What is the problem? What have I done? Right. So like Ray says, I'm curve fitting or overfitting the strategy, right? So this is like the biggest sin when it comes to data-driven strategy design. People have a tendency, and it's very easy and very lucrative to fall into this pit hole, that you use the entire data set to create something and keep making optimizations to it, tinker it until that backtest looks good. The problem is, more often than not, such a backtest will only look good like historically. The strategy only looks good on historical data. It doesn't perform well on real data, like in life, simply because you've overfitted the strategy to the point. And this is even easier to do when you have a lot of parameters to work with. So one of the simple reasons why a lot of people think, when you've created strategies on StockMock with this limited data or whatever, you might have just overfit. It's very hard to overfit when you barely have anything to work with. like you have a target stop loss, which is like a trade property. And then in terms of signal, you just have an entry and exit time. So it's pretty hard to, and like there are some other parameters also, right? So the strike and the structure and whatnot, but there aren't too many parameters. Like you might have seen, or I know I have seen people who have like 10 different indicators on the chart. You know, when this happens and that happens and Falana happens and Dimka happens, that is when you take a trade. That is when you're very, very likely to overfit because you have different time frames, different indicators, you're trying to match them, this, that. So that's when you're very likely to do things like overfitting, especially when you're trying to make a systematic trading strategy out of it. However, with this things this simple, at least it's very hard to do. But we'll still hedge against something like overfitting just by using a very simple idea. We'll split this data set into two parts. This is what we'll call train. This is what we'll call test. Train is where you will build your strategy. You'll prototype it, you'll tinker with it, you'll optimize it, make sure it works well, and do so in a way that you try not to overfit to just this, right? You try to have like a general framework that will perform well over here. Then once you're absolutely solid, yeah, now I'm good. Yeah, training pay, I've created what I was looking for. Now here's the hard part. You're going to run that thing on test. So here's what you'll do usually, right? You'll pick a framework for a strategy. A framework would be, like in our case, it's straddle selling on expiries. It could be a moving average crossover for Nifty. It could be a Bollinger Band reversal on, you know, for crude, whatever. Like you have some framework. Then you will have the parameters that if I'm doing moving average crossover, am I going to do 50 200? Am I going to do 1325? Am I going to do 5 and 500? What moving averages am I going to choose? So these are the parameters that you optimize in this training data. And you also get more nuanced and split this training into like a train and optimize and then you test. And how much you split this, all of this stuff. I mean, it's not worth getting into right now. If that is the kind of information you want, you know, just look around, learn a bit about data science and how these things work. But with trading, you'll probably have like a framework. You'll choose a framework, whether that be moving average crossover, some combination of indicators, this, that. Then the parameters that you'll tune in it. Okay, this moving average goes above this moving average, or this exponential moving average crosses this hull moving average, or whatever the parameters that can be optimized. And then you'll finally test it. Now, here's the thing. Done properly and done diligently, the idea is when you go from this to this in the training data, and then you go here to the testing data. If this thing does not, if this framework plus parameters do not perform well here, what most people do is they'll get rid of this and go back to working with this framework. The same framework, they'll try and tinker with new parameters. The problem with that is, for example, you created something, created some parameters, you came here, you tested, it didn't go work well, you went back and trained to new parameters. Then you came back, you tested, you're like, oh shit, this is also not good enough. You go back, retrained the parameters, and you came back and tested again. What is the problem with this? Guys, tell me, what do you think is the problem here? If I train something, then go to test it, and I don't like the results, I go back and, you know, retrain the parameters. All right, so Manas has used a very fancy word. He's saying the data is burned. So what it's essentially saying, or, you know, a simple way of just putting a very, very fancy word, Manas, I like it. Good one. It's just that now you're just overfitting to this test data set also. This was supposed to be like a never before seen data set that will work as the final test. Like this is either pass fail. What you're essentially doing is you're going here, checking if it's pass fail, and if it's fail, you'll go back and, you know, try to do some tinkering and test again, and keep doing this till this becomes a pass. Now what is happening is you're not just overfitting to this test data, right? So that is also not allowed, or you shouldn't be doing this. So, and great quote by Ravi sir is, if you torture the data enough, it will agree to anything. And in this case, that's very similar to what you're doing, right? At this point, you're now torturing the data, or at least, you know, like optimizing your strategy parameters to the point that it just agrees with you. Ki, हाँ यार, चल, test maybe pass करिए, right? But again, the problem is this might not work into the future beyond, say, April 2020, right? And now to avoid this, It's a very simple idea. You do as much as this you want to. You pick a framework, do parameters, use all your techniques that you have, right? Lilo's talking about, or Lijo Jacob is talking about something called k-fold cross validation. Uh, you could do that, you should do that, but again, that is beyond the scope of what I'm trying to teach here. I'll stick to the basic principles. But of course, there are many good ways to check for whether you're overfitting, how to avoid overfitting. Use walk forwards, Monte Carlos, k-fold cross validation, a bunch of techniques in the data science community that you can use to make sure that you're not overfitting, analyze the robustness, sensitivity. But all of these right now to most of you are probably just going to be fancy terms. So instead of going into those, I'll just explain to you the basic principles behind this. And then if you're more interested in learning further, you can, look it up, Google it, watch YouTube videos, do a course, or just ping me here. This is what I was trying to do. This is what, and again, if you're pinging me, try and make them targeted questions as opposed to please teach me this. Right? If you just want to learn something, go to YouTube. It's probably there, right? So back to the point. All you should do is pick a framework, do whatever kind of analysis you want to, whatever optimization, pick the best parameters for the training set, try and make it general enough, check the robustness, check the sensitivity, make sure you're not overfitting. Once you're solid on this, yeah, this is my strategy, yeah, this is going to work, and you take it to testing. If this works, great. If it does not only do you have to can the parameters, you also should ideally can the framework. You should not stick with this and train the parameters again. You have to get rid of this framework. Because if you still play around with this framework, you'll eventually just start overfitting these parameters to the test, right? So get rid of this framework, can it, and just move to a new thing, move to a new idea, move to a new asset class, move to whatever. You cannot cycle this process again and again. This is not an iterative process. This you can do as many times as you want. As soon as it touches this, it's done. Either it made it or it didn't. If it didn't, throw it away, don't look at it ever again. All right. And this is very rare. I actually know of only one other firm apart from our own that follows this diligently. I only know one, and I know a lot of firms are doing like systematic or quant trading. There's only one firm that I know of that does this the way it's supposed to be done, because this is a very easy pitfall to fall into, right? So now we'll be coming back to StockMock to do this. So we're going to split into train and test. We're going to, the framework we already have, we're going to play around with the parameters a bit, make sure we're solid on this. Then we'll go beyond StockMock, and I'll use Python to show you guys, to account for things like slippage and cost, which aren't on the platform yet, but they very soon will be. But right now, to operate within the limits that we have, I'll download the data as a CSV, I'll import it into Python. And of course, I'm aware that a lot of you aren't familiar with Python, so don't stress about what the code is or what it's doing. I'll, every step of the way, via comments also, I'll explain what that piece of code is doing and what the objective with it is, right? That is what we'll do when we meet again in 10 minutes. I'll go have a sip of water, eat something, and actually I'll make this 15 minutes. We'll meet again at 1. You guys feel free to go have a sip of water, eat food, go to the bathroom, and we meet at 1 o'clock. All right. And in the meantime, if any of you have questions, feel free to just pop them into the chat box, and I'll have a look and get back to you when I'm back. All right. So break for 15 minutes, and we meet again at 1 p.m. And we're back. I hope you guys are also back from your respective break activities. So it's 1 o'clock. It is pretty evident to me at this point we'll probably not complete by 2. So it's probably going to extend till 3 at least. And I hope that's okay with everyone. In case it's not, feel free to leave and just watch the remainder when the recording is uploaded tomorrow. But I assume that's okay with most of you, right? Like if we extend this to 3 p.m. Cool. All right. So let's continue with. Just give me a second, guys. All right. So now we do the strategy design on StockMock, right? So the first thing to do here is to split our data into in sample and out sample. So the in sample is up until the 25th of August 2019. All right. So Feb, March, April, May, June, July, August. So those 7 months will serve as the in sample, and then post August, September, October, November, December, Jan, Feb, March, April. So the next 7 or 8 months will serve as the out of sample. In sample is another word for training, and out sample is another word for testing, right? So all our tinkering and the strategy design will do with Feb 15th, 2019 to August 25th, 2019 data. All right. Now, the first thing to think about is, I mean, there's not too much to do anymore. We are selling straddle, so the strike is chosen, the data is chosen. So now these are the 4 things we have to work with. We already decided not to have targets because, I mean, in my experience analyzing data, targets have almost never helped. Plus, it is, sort of against the principle that we are working with is key. We cut the losses, but we'll let the winners run. Letting them run basically means we won't have any kind of target. We'll hold them till the end of the day. All right. So no targets. So the 3 things that we're now left with are the entry time, the exit time, and the stop loss. Right. So uh, reasoning about this, just from first principles, because we know on expiries, our theta decay is going to be the maximum. It's going to be at its peak. We want to get in as early as possible, right? We know this is going to be a money making day for us more often than not. I mean, from a principal point of view, so we try and get in as early as possible, right? I personally know people who start, firing orders, 15, 20 seconds, 30 seconds into the market as it opens, assuming it stabilizes by then. So now I have to choose my entry time. So the earliest I can choose is 9:15. But like I said, entry at 9:15 is not really practically possible or feasible, right? You won't get the price at the 9:15 open for your fill. 9:16 is still feasible. 1 minute into the market expire, 1 minute into the day, into the trading. So the first candle is usually like a very big candle, but post that, the spreads usually get tighter and the market starts stabilizing. But just to be on the safer side, we're not even going to pick 9:16. Let's just go for 9:70. So 9:15 definitely doesn't work. 9:16 might work. 9:17 will, almost definitely work. Like it's a very comfortable time to start trading at on expiries. Essentially, especially when your trade is just very simple, you just have to sell a call and a put at the money, right? And now we're going to be essentially in this case selling the at the money call and put at 9:70, right? So that is the idea. So this is pretty simple. It's just reasoning from the basics here, because I know my theta decay is at its peak. I want to capture as much of it as possible. How do I do that? I just don't wait too much before I open the position. I open it as soon as possible. And 917, at least for this backtest purpose, is the earliest we can do without taking assumptions that are too, that might not translate into practice too well. Right, 915, 916 entries might not work, but 917, 2 minutes into the trading day, most prices have stabilized as far as being able to enter a trade is concerned, right? And the spreads have tightened, especially on expiry days. This might not be the case for something like a Friday when a new expiry, like an option expiry chain begins. Many times the spreads are wide. Many times, if there's a gap, especially like in the recent past, the Friday chain might be frozen. It might open in a circuit, but more often than not, 917 as an entry will work. So that is what we have as the entry, right? That's what we are starting with. We can choose to optimize this later, but right, let's just stick to 917. Now the exit time, like we have decided, we let the winners run as much as possible. So we'll hold it till almost the very end of the day. We'll exit by say 3:15 in the afternoon, because especially when you have those MIS intraday orders, most brokers ask you to square it off by 3:15, 3:20. Most I think after 3:20. If you have those positional orders, you can do till 3:25, 3:28, 3:29. But just to be on the safer side, we'll square everything off by 3:15. Even though there literally isn't a risk of ending up carrying the position overnight because the contract has to expire at the end of the day. You won't have a case where on Thursday the thing is expiring, you're not able to square off and you're holding it into Friday. That isn't possible. However, your broker might charge you some additional fee if you don't square it off, and they have to square it off for you or some nonsense. So not worth it. Let's just be on the safer side and square off by 3:50. Right. So with these two, choices, entry and exit time, are there any doubts about it? Right? Because again, it's very simple. So there's not much to discuss or debate. Of course, you can move these around 1 minute here or there, 5 minutes here or there. But I'm again thinking from first principles. I want to get in as early as possible and stay in there for as long as possible without, running into risks of uh, assignment. I mean, there's no assignment in this case, to be honest. But still, I'm just being on the safer side of getting. So that is that. Just give me a second. Yeah. So that's done. Now, next, what we have is a stop loss. Now, this is something that a lot of people have asked for, and we know we should have it. But so having a stop loss on the percentage amount of the entire straddle. So, for example, the call and the put. Right now, you can have a stop loss on the total amount of the PNL that this generates. However, and like Akash sir suggested earlier, that you have say 5% stop loss on the straddle price. That isn't a feature that we have yet. You can have like a per leg percentage stop loss. Here, I'll put on the call and the put respectively and square off the leg or square off the entire straddle. However, that's still you trying to make an approximation how it would happen, or per leg points where you square off one or square off both. I think it's, just for the sake of this demonstration, I'll just use a total amount, like a numerical amount. And when you guys start testing, feel free to experiment with other ideas and different amounts and whatnot, right? So now my idea is that I want to have like a tight stop loss. So let's say, and because I'm selling one lot right now, so that's 20 units. Say I have like a stop loss of, say $300, right? Seems like an okay amount. There's no target. You can, of course, try something smaller, say 100. Meaning that if the straddle as a whole goes 5 points against you, which, so I don't know if you guys have traded straddles before, but usually, because uh, often because of the delta moves, the put and the call prices will be canceling each other out. So, for example, if the price as a whole is going up, like unless it's like a massive run up where one almost runs out of delta and the other one edges to one, then you'll have like a solid delta exposure on one side. But by and large, if the price is just like dancing around or not going that extreme, the straddle prices won't move as violently, right? So, but 5 points against you might seem too tight. So, I'm just going to go for something like 300 points, just to be on the safer side. But we can, of course, tinker with this parameter also. So this is it, right? So I had three parameters to work with, but we're not having a target profit. Now, Mahesh is telling me these days there's no, he's saying that there's no STT penalty for non-execution of ITM options these days. If that is the case, then we can go straight for hold it till the end of the day. I've never had the risk of holding anything post 350, so doesn't matter. But right, so if you're saying let's do that, not a problem, right? Pavan is saying, can you please put 100 quantity for Bank Nifty? I mean, I just feel it's much better to test with one lot, and then once you get the numbers and you prototype, then you multiply it by 5 or 100 or whatever, whatever quantity you're trying to trade or whatever you're looking to do. Like one lot is like the standardized thing, right? All right, so race countering that, can we please stick to 15-15 because he doesn't want let's say the yeah. So the margin requirement will become an issue if you're trying to sell with the normal orders. So you'll have to pay full margin. So again, all right, let's just do 315. Let's not stress about this too much. It's not right. Worth worrying about. Again, this is me trying to demonstrate to you the idea of like having like a simple concept, having a simple platform that lets you play around with it, and then of course post this. Feel free to experiment, right? And fuck, post this. Right, I'll do this here, and then feel free to right now within the webinar for the next 5 or 10 minutes. I'll have you guys test out different ideas, right? So don't worry about it. So Aspire is asking, bro, can you explain 20 put and call, how you take that? Bro, that 20 is the lot size. That is the number of units in a single lot of Bank Nifty contracts, options or futures. That is going to change to 25 in June, I think. In the June expiries onwards, the size has been revised to 25. However, 20 is what is running right now and has been in the recent amount, right? So Nankishore sir is asking why I have a 300 rupee stop loss. We can have anything else. We can have 500, we can have 1000, we can have 100. I think is too tight, and I don't want to have too big a stop loss because I want, as per my principle, I want the stop losses to be tight, right? So, and so 300 here is on the entire straddle amount, right? The What I'll do is I'll just run the back test and I'll show it to you, right? So I run the back test. Now it'll take 30 to 40 seconds, and no, it's not 300 into 40. It's 300 on, like, as somebody said, on the MTM or the mark to market, right? So as you can see here, so it says 300, 300, 300 are my losses. Then I made 69 bucks on this one, then 2071 on this one, then lost, then made 776. So this is what the backtest report is, right? It tells me my overall profit, the average expiry. Expiry here means the average expiry chain profit, average daily profit, max loss, total expiries, number of winning days, number of losing days, average win on the win day, and average loss on the loss day, right? So all of these are intraday trades, right? But it's just grouped them by expiry right now. We can choose to group these by days. For example, different like days being Monday, Tuesday, Wednesday, Thursday, and the way I like to look at it, by date. So it's just one running, every date is there. Arvind is asking, where can we find RV? You can't find it here yet, but again, all of these are things that we'll introduce. IV as a thing we'll introduce. RV is, again, realized volatility is something you'll have to calculate, and how you choose to calculate it or what metric you choose to use is up to you. But that's beyond what we're trying to do here. Right now, we're just working with very simple things, right? So it's making, right? So it's making like 28 1,000 rupees in total in a matter of whatever, like 7 months. Where so right now this is for all trading days, right? So we're refining it in a bit, right? So this is what your PNL looks like, and this PNL also tells you the exit time. When did you exit? So like at 9:21, 10:57, 10:2, 5, 15, 15, 3:15, essentially, so on. So now one thing to check, is the stop loss too tight? One way to check is if I'm entering at 9:17 and my stop loss gets hit right at like 9:17 or 9:18 itself, then it would be an issue. That means my stop loss is too tight. So if I make this say 20 rupees, right? If I make this 20, uh, and then we look at this, now my stop loss gets hit like almost in a minute, right? There are days when it doesn't get hit, but right then it just gets hit almost in like a minute in many of the cases, right? Which is a bad idea. That means the stop loss is way too tight for this to be practical. So I'll just make it like 300 in this case. Seems like a very reasonable number. If you want, we can experiment, increasing or decreasing, right? So right now, this is what your backtest, the plain vanilla backtest for this strategy looks like, right? Now, what it is right now doing is telling you how it performed on every trading day. Saturday is here because of those Diwali nonsense sessions. I would never advise you to trade those. I don't know why anyone trades those. Apart from, if somebody has auspicious reasons to lose it, I would never trade something like that. So right now it's trading every day, but our strategy is to only trade this thing on expiries, right? So what I'll do is I'll just not select all the other days, and now what remains are only my profits on expiries, only on Thursdays. Now, for example, this expiry, 20 March 2019, happened, probably not on a Thursday. 20th March was not a Thursday. Maybe it was a Wednesday. Maybe it was a holiday, right? Um, so people are asking how was the overall profit higher in 20 rupees? Uh, Simply because, if your stop loss is tighter, then your losses are much smaller than your profits are. But again, in that case, that isn't a realistic scenario, right? So uh, it's we would rather backtest something that is realistic and will actually work in the real world, as opposed to backtest something that looks good in the backtest but doesn't work in the real world. There will be no point doing that, right? Uh, so this expiry does not mean only expiries. It means holding things on expiries, like position, like in what is the opposite of intraday? It means position. So that is what this expiry means. All right. So so here we want to stick to intraday, right? Now Mahesh is asking 300 is real for 2 leg option. Yeah. Uh, I mean, of course, you can increase or decrease this, but what's a good way or like a simple way to? So I don't know if you've traded straddles or not, but okay, I'll just make this 500, right? So again, the simple metric to check this by is how quickly is my stop loss being hit. Again, here also it's a very comfortable time. As long as it's not getting hit at like 918, 919 after a 917 entry, I would be comfortable, right? So the now it's worth looking at what is the average kind of profit that we're making in winning days, right? If I look at the average profit in this case, I make 1,430. I can then try and play around with this to sort of maximize this, right? Or maybe try and maximize the average daily profit by getting rid of these nonsense days. All right. Uh, Suresh sir is saying do some fancy things, so we are only testing for expiry. I mean, you can do that, but I think for the purpose of just prototyping, this will work. You can, of course, choose to be more diligent in the way you test, which, as you've figured out ways to do so, feel free to, right? My objective with this is to prototype and get you guys started with something that, is going to work. Those edge cases you should account for, but, even simpler is If the expiry is on a Wednesday, just don't fucking trade, right? If Thursday is a holiday, just chill, right? Why not? Why worry about this shit? So just take a day off, relax, and given the machine's trading for you anyways, you don't have to worry too much, right? So again, a lot of trading is about not being anal about the little things, right? Just if the like be as general as possible. People want here, I want this super trend on three different time frames to align, and then the no short thing brings no short thinkage, which is itself made of like three different indicators. When this goes here, and then when the delta of the option is exactly this much, that is when I'll buy, right? I was also on like similar lines of trying to create super sophisticated and finely tuned trading systems earlier. However, this site is largely the reason I have decided that such a thing is not required. All right. So now people are asking, capital and all these things. We'll get to them. We'll get to them. Right. Right now, just this is what we have as the backtest. Right? So now we can, so right now we have chosen the framework, we have run some back tests. Now we can start optimizing things, right? Maybe I can move my entry times around. So maybe I move this later. Let's see what happens. Maybe I move this to 9:45. How does that change the results, right? So just on Thursdays, my average daily profit was this, and my total profit was this. Just clock this one, right? Now I'll run this with a new time, and then let's see what we get on Thursdays. Right? Now my average daily profit has gone down a lot. It's almost like cut in less than half, and my overall profit also similarly has been cut down a lot, less than half. So, and the opposite of this, maybe I can try pulling it inwards. I'm already at 917. Let me try 916. Let's be a little optimistic. Be like, I'll probably get in at 916. Say high frequency trading or whatnot. I have an ultra low latency execution, or maybe I'm market making. Now, when I get rid of these days, now I see my average daily profit has gone up by a lot, right? And similarly, if I just pull this even further in, if I say, yeah, I'm able to get in at 915, and then I run this, then it's going to be fuck all numbers, right? Again, but this is not tradable. Do not try to run or go by the numbers you see here, right? So let's see. It's taking a tad bit longer to test the yellows, but now if I do only Thursdays, now see, I mean, compared to 917, my profit is more than two times, right? I'm winning on a lot more days, and it's a beautiful looking PNL. But again, this is simply not possible. Now Mahesh is saying, if the machine is doing it, why not 916? I'm It is possible to do it at 916, and I know someone who does it manually at 916. Like, fuck the machine, you can do it manually also at 916. But it's I mean, it's a risky assumption. If you want, we can work with 916 also. But just to be on the safer side, because I wouldn't want to misguide you guys to do things that won't work. I'd rather give you the simplest and the safest things to work with. So let's just stick to 917 for this. Now, working with, say, the square off, if I pull this in, right, instead of, I'll say square off at 215 instead of 315. Let's see what that does, right? Now I'll get rid of these. Uh, wow, my average profit slightly went up if I square out at 250, right? As opposed to 350. Earlier, this was like 600 something. Now it's 700 something. Interesting, right? Uh, why is that the case? Maybe because, like in the last few minutes, there's very little theta left for you to eat, anyways. And adverse sudden moves, like Mahesh is saying, karma, which is at its peak as you're very close to expiry, might be eating into your profits a bit. So let's see if we can pull this in even further, and maybe the numbers are improved. You know. Uh, no, so bringing it to say 115 then starts to adversely affect your returns. In this case, at least the average profit that we're working with in our example is you know it's not helping us anymore. So let's just go back to right. Uh, hmm, now Himanshu Tiwari is asking if we are not allowed to trade before 9:15, then why the system allow us to even choose a time under 9:15? It doesn't. It doesn't let you choose anything before 9:15, and it doesn't let you choose anything after 3:30. I don't know where people get all these bright ideas. I mean, for some reason, I think people have this like superiority complex or like this, messiah complex. Like, you probably know more than everybody else, or you know more than. I mean, the people I'm not talking about myself, but the people behind this platform are like super, super, super smart people. Like in terms of like technical proficiency, these guys are. I'm not even saying this like as a hyperbole. These are literally some of the most talented technical people in this country, right? So as far as like things like coding and all is concerned, and optimizations of the database and queries and things like that, right? So, I mean, trust other people a bit, right? I mean, don't be blind in your faith, but at times give other people the benefit of the doubt, and at least when you're asking me why is it letting you choose this, at least take the time to check if it's letting you choose this, all right, as opposed to like just saying why are these guys letting you choose this, because they're not. Whatever you're thinking of, they've probably thought of that before, right? And whoever's using the annotate, please don't, else I'll be happy to kick you out. Cool. Nandkishore, is there a way to check optimum parameters for max average per day? uh, Very good point, sir. Right now there isn't, but we'll add that very soon. That's like one of the top things on the to add like an optimizer for the search. But again, the thing is, something like an optimization is very expensive to run. So we'll have to figure out how to do that well, right? Um, right. So is it good to make adjustments on the straddle strategy, like changing the strikes once? Sham is asking. That is not what the backtest allows you to do, and that is not what the backtest is doing. So number one, that is beyond the scope of the backtest. Number two, if it's not backtested, I would never do it. I would never touch it. All right. And number three, if this is profitable, right, and unless you think your adjustments or your modifications are going to have a massive impact on how profitable the strategy is, then what is the point, right? Uh, Again, with B Bandla is asking me, can we do more than one trade if the previous trade has hit SL? Again, is that what we are backtesting right now? It is not. Can you do that in the backtester right now? You cannot. But are there ways to backtest that? Of course. But again, this is, I think, another problem with people. Instead of just sticking to what there is and working with that, people want to add unnecessary complexity to things, thinking they're smart enough to make it better. Believe me, all you're adding is fragility to the system. लाइक यशराज इज सेइंग, मतलब तुम लोग जबरदस्ती उंगली कर रहे हो स्ट्रेटजी की, जो स्ट्रेटजी पहले प्रॉफिटेबल, अच्छी खासी प्रॉफिटेबल है, बट उसको उंगली कर करके यू विल एंड अप ब्रेकिंग, राइट? जस्ट स्टिक टू द सिंपल शिट. If the strategy is key at 917, just sell the strategy and square it off at 315 or 215 or 245, whatever, right? Just do that. It's super simple. If it's profitable, just do this, get done with it, and then go for a new one. Now, Pratap sir has a valid question, right? He is saying here I failed to execute on this strategy manually because he wasn't able to put the SL on both legs simultaneously, which most brokers do not allow you to do. So I'll show you guys how to do that. Now that, Pratap sir, is a very fair point which you've raised. But for everybody else raising points like, yeah, can I adjust this? Can I do this? Can I do that? Can you? Yes, be my guest, right? But then the you know, whatever be the outcome or the deviation from the numbers that we're seeing because of what you're doing is on you. It's not on me or the platform or anything else, right? Uh, so the, it's beyond the scope of what we are doing, and it's unnecessary complexity added to something that works. If it's not broken, don't fix it. You don't need to fix something that's already, working, right? So, and I think this is because a lot of people have a hard time, and this is why even I had a hard time uh, you know believing this initially, was because I was like, इतनी simple चीज पैसा कैसे बनाएगी? What इतनी simple चीज जब पैसा बना रही है, why do you want to struggle with this? Yeah, and if people want to be firefighters, they want to repair broken trades. Just take the fucking loss, move to the next expiry and do it again. And because it's a positive expectancy strategy, just keep fucking doing it, stick to it, and it'll make you money, right? Just stick to it. It's as simple as that. I I think a lot of, and I think this is also in some people's, in some people are incentivized to do this. A lot of trainers that you've learned from probably have, they run sub brokerages, which they get you enrolled on, and they teach you to do this adjustment, do that, falana dhimka. Why? Because they're getting something in their pocket every time you make a trade, right? They, honestly speaking, most traders do not even have your best interest as their primary goal. They are just trying to fill their own pockets at the cost of your pockets. Whether you make money or not, they don't care. You do adjustments, you do repairs, you do 10 trades after the stop loss hits, they're happy. Because every trade you make, you might not make or not make money, they will, as sub brokers, right? Here, all I'm trying to do is give you the simplest shit. Like your repairs, your modifications will cost you brokerages and slippages and costs to implement and additional complexity. I'm showing you something that is effectively like just two trades in a day, getting in and then two trades coming out, and that's it. That's all you have to do, and that is, by the numbers making you money. How much money, it'll become clear in a minute. All right. So Nilay Jasani is saying show percentage leg point through stop loss. I don't get it. Again, let's right now just play around with these parameters that we have right now. So somebody said, let's test, 245. Let's do that. So right now we are at 700. Let's see if this helps. Again, remember, we're doing all of this on our in sample, so we can tinker as much as we want. So 245 isn't as good as 215. It's still pretty good. It's profitable. It's profitable 36% of the days, and loses 64% of the days. So it loses more often than it wins, but it makes a lot more than it loses when it wins, right? So it's very similar in framework to trend following systems, except your trend following here is more on like volatility, where you've shorted it, put a tight stop loss, and if it goes in your favor, it'll keep going in your favor. Right? So somebody's asking, why don't we take 1:3 or like that? Simple now. You'd wish it was that simple. Feel free to play around on the platform, right? In your own time, at your own pace, play around with it, right? So let's just stick to say 245, right? For the sake of demonstration. Now I'll try moving the stop losses around, right? I'll make it bigger. I'll take it to 1,000, right? So right now we're at say 655. We run this. Let me get rid of this. Now the average daily profit goes down because my losses have increased, right? My average loss has increased. So now I'm not, earlier I had like a 500 rupee average loss and a 2,500 rupee average profit. My profit remains the same, but my loss doubles. So on the net, I'm not making as much money. Is it, so next, the question is it a realistic stop loss? Most definitely, right? My exit times are way away from my, like the way after my entry time. So it's not something to worry about. So now let's see if we can start squeezing this. So maybe at 200, let's check. So it's like 10 points on the lots, right? Um, let's see how it affects the profits. So the profits most definitely spike up. That's a good thing. I'm making more money the days I'm making money, and I'm losing a lot less. My risk reward average, when the average loss is more than 10 times, almost 15 times when I win, right? Now it makes sense to see, is this stop loss feasible? If I entered at 917 and my stop loss sits at 215 or 216, then it's pretty fair, right? It's not if I entered and instantly got hit, because in that case it would be a problem. Now here also it's 954, 935, pretty safe. So now here it's pretty tight, like on 917 entry, 2 minutes later the stop loss got hit. But as it turns out, that doesn't really seem to be the trend. Oh no, in some cases it is the trend. So 919, 942 is okay, 918 is pretty tight, 918. So I'm seeing too many 918s for my comfort. So I'll push it back up again. So let's go for 300. Again, something we started with. Let's see how tight the SLs are on this. By tightness, I'm just trying to, get a good idea for if I was to execute this trade, will I just get stopped out as soon as I enter because, like the price instantly moved against me a bit and I got stopped, or can I just sit in there? So Rajesh sir is saying change the entry time instead. So we already tested like going ahead and coming behind. The earlier we start, the more the profits, and 917 is the earliest feasible or practical entry time in my opinion. So again, feel free to experiment further with different entry times, different stop losses. So now my profit has gone up even with the tight stop loss. But let's see my stop loss exit times. So not tight here, here it's 920, not bad. It's 3 minutes after my entry. This is a tight one. So that's bad, but 3 minutes, 3 minutes. This is a minute after my entry. I mean, it's okay. We can make it even more relaxed. Here go. This is without stop loss. Yeah, this is without stop loss. So without a stop loss, it is no longer a profitable strategy, right? So you have to put a stop loss there, right? Even though you're winning on more days than you're losing, but you're losing a lot when you're losing, right? So this is one of the ways to know that you should have stop losses in your strategies, regardless of what you're trying to do. Even on Thursdays, it's a winning strategy. It wins almost 50% of the times, but my average profit is pretty low because my losses are pretty high, right? So stop loss is a good thing to have. So let's see 400, right? Decent profits. 1918, another 918, only two 918s. It's not too bad, right? Yeah, we're still in the in sample. We're still in the in sample. Uh, I mean, right now I've just split the data set exactly in half. If you have better ideas to split data sets, feel free, right? I'm just giving you, with the limited time and features that we can work with right now, I'm just showing you what is possible, right? So Sahib is checking. Please check for non-expiry also. So right now the objective is to build something for expiries. But again, my objective is not to give you like 10 different things today itself. I'll give you one, and I'll give you the platform where you can make 100 of your own, right? After that, it's entirely on you, right? You make non-expiry, just something for Wednesdays, and there's also alpha to be had, just on Wednesdays, or like returns to be made on Wednesdays, because that's what we call mini expiries. So there's good theta decay there also, and you can play those. You can experiment with going from Wednesday to Thursday overnight position, but again, be very careful with overnight short option position. Very, very careful. Actually, I would go so far as to say just don't do those. Like it's not worth it, even if it is uh, right. Even if it is profitable, I just don't think the tail risk that you're taking shorting options overnight is worth it, especially when it's like unlimited risk. If you're going for overnight stuff, go for like condos, iron condos, where you're buying wings on the side to make sure that your losses are limited. But again, overnight selling, is it profitable? Yes, but I wouldn't suggest you go for it. Like it's very dangerous. Uh, so yeah, so again, for everybody who's suggesting ideas, just try it out yourself, right? The platform's available to everyone. So Harsh is asking now. This is a good question. Can we know the drawdown percentage in this platform? Unfortunately, we cannot right now. That's one of the things that is to be added in the statistics. A couple of things that I've suggested in terms of the Sharpe ratio, Kalmar ratio, drawdown. So all the numbers right now are in what do you say? Uh, like in rupee terms. I've asked for percentage terms also, percentage compared to the capital that will be deployed. So you can choose, what kind of orders you're doing and what is your margin required on your trades, so on. So yes, those things are to come. But your drawdown question I'll address by taking this data into Python, right? So right now we're at 400. I think let's say this data is good enough, right? At 719 rupees of average profit on the expiry, average day profit. My average, the average profit I make on a winning day is like 2,711, which is pretty decent, right? So let's check this out. So over the course of these 6 months, over the course of the 6 months, I make about 18,000 rupees, right? Now, important, this does not account for things like slippages, cost, anything. So that is something I'll now add by taking this data into Python, right? So before we go there, are there any last minute optimizations that anyone would like to suggest? Let me just go back to 315 and check if uh, there's anything. So this is 719. Let's see what 315 gives me. It's less than that. So I'll just stick to 245. Right. So this is what I have, and this is what I'm sticking to. Now here's what you can do. Like for example, this right now is certainly limited in certain things it can do, but you, because you're smart, know that there's more to be done. You export it as CSV, and then whatever your tool of choice, Excel or I don't know what you guys use for this, Google Sheets, whatever, take it there and then work with the data there. Now, what I'll do instead, because my tool of choice happens to be Python, I'll fire it up and we'll continue with our analysis there, right? So what do we have here? So I'll just jot it down. The strategy that we have so far. On Thursday at 9:17 a.m. Sell at the money straddle. How do you spell straddle there? It's a single and double straddle. So this is my entry. Exit at 2:45 p.m. or at uh, your PNL being less than equal to I think it was minus 400. Right. Good. So that's the strategy, right? This is right. Now what do I have to do? I have to make sure this thing works after slippages and costs, right? Right. So now in Python, I'll import the stuff that we usually require. Now what I have to do is get this file that I've downloaded. What's it called? Short straddle. Short. Which is the one we downloaded just now? I think this one. But, right. So here's the file. All right. So again, people are suggesting please try 3 straddles, or would the straddle be eligible for the new reduced margin framework for hedge positions? No, a straddle is not a hedged position, so it won't be. From what I know, I mean, I haven't read whatever those new guidelines or frameworks are, but this isn't a hedged position, to be honest. Um, I mean, it is delta hedged, so maybe it is. I am not 100% sure, to be honest. I haven't read those guidelines, so I really don't know. But so I'll just get the, say this is the data. So I call this the StockMock data. Import StockMock CSV. So for the people who aren't familiar with Python, I'm just importing all that that PNL file that I downloaded into Python, right? So here I have the date, the profit, the exit time, the spot change, the sell, the entry prices, and effectively the exit prices are also in there. So now what do I want to do? First, these aren't numerical numbers, or like these aren't numerical values yet. They're all strings. There is something called profit, profit, profit in every other row. So what I'll do is I'll get rid of those words wherever it is not equal to profit. Those are the rows that I want to keep. So now all that profit, profit, profit disappears, right? So it's not too many files. It's like 48, so 49 trades. So this is the data that we're actually working with. Right? Now there are no NA values or anything else, but just in case I'll add a drop NA in case, right? So get rid of you say rows with nonsense values in them, right? So that's essentially what I've removed that command. Now what am I interested? So this is what now my profit is not a number yet, so I'll turn it into a number. I'll use floating point number. Yep, this is now a floating point number. And now what I'll do is I'll just plot the equity curve. So this is what our equity curve looks like for our in sample data, right? So it makes money, bunch of money. Then it has been on like a losing streak or lost a couple of times, right? No problem. It's still net profitable, right? Now the question becomes, will it be profitable post our costs, right? So what I'll do is I'll extract the entry prices and the exit prices from this information that I have here. What I'll do is I'll do like a bit of Python jugglery here. The Amadeus students should be able to follow along with this easily. And those are my entry prices. So this is my CE entry, right? The same thing I can replicate for my PE entry. Now next, what I want to do is get the exits. And split it with this. Let's split it with something else. This is a split. Take the first, and then split with the equal to. Take the first of those values. These are my exit prices. This was C entry. This is C exit. Similarly, the same thing can be replicated for PE. So let's put all of these into a single lot. And so now these are all in a separate column, right? Let's see. Now what I want to do is, because these are again not going to be numeric values. C entry, C exit, excellent. Yes, P entry, C exit, P exit. Let me just start from scratch. C entry, C exit. Actually, it would be better to arrange the rows as such. Not the columns. C exit, P entry, P exit. Okay, so these are those values. This is where I sold the call. This is where I covered it. This is where I sold the put. This is where I covered it. So those are what these values represent, right? Now, Prateek is saying no voice. Is that an issue anybody else is facing? So it's Prateek. I'll just tell him to join with what? There should be a button on the bottom left. All right, so now I will convert all of these also into floating point numbers and just assign them back. All right, so there we have it. So now I have the C entry and exit prices without any slippage already there, right? Now what I usually do is have, or at least, my observation and what our numbers have shown is that, 1% of the option contract value is a sufficient like slippage number, right? So essentially, if I were to deduct 1% of entry, then 1% of exit of first the call and then the put, this should be a sufficient estimate for my slippage, right? So what I'm going to do is I'm going to take these numbers. I'm going to add them up and I'm going to multiply them by 0.01. That's like the slippage per unit. And because I have one lot each, so I'll multiply that by 20. So that is my total slippage per trade or, on every trade. So that is what I'll deduct from my total profits. So I'll just make this a new column called slippage. All right, stock market. Right now, what I'll do is take profit and I'll subtract my slippage. The fuck. There you go. So this is our profit post slippages, right? So before slippages, I'll show you. Before slippages, our profit was 1500. Wait, is this 1500? Right. The total profit is around 18,000, right? Post slippages, we have lost, about. Have I taken slippages properly? Let me just make sure. Multiply that, multiply that. Exceeds 1. Yeah, fair. So I've lost, say, about 200 points in total in slippages. So my profits went from 18,000 to 16,000, right? But if you look at the graph, it still is a profitable strategy, right? And 1% per trade is a pretty safe when you're dealing with options, like a pretty decent assumption, right? Now, if you would like to include, like, even though transaction costs at this point are a very small number with most brokers, and because here all the numbers are on like a single lot, so adding transaction costs for those trades will adversely affect these, to a very high degree, simply because even though I'm testing this on one lot, that's probably not what you want to trade for real. Like, that's very small capital, very small profit or losses. I think it's an insignificant number to your bottom line. So you'll probably have like a bigger lot size, at which point, these. So let's just, be safe and multiply that slippage by, instead of taking 1%, we'll add like another 0.5%, and then see, right? So we've read it by another like 1,000 points, right? So originally we lost 2,000 points into slippage, and we've gotten rid of like another 1,000 points by or let's just multiply it by 2, right? Even though this will be like very harsh on the strategy, like, it's still profitable, right? But this you probably should not, unless your execution is absolutely trash. Like, you're probably like sending orders manually very slowly, or like in a very poor manner. And like, if you're trying to do this manually, have a broker that allows you to send like 2 legs at once. If you're trying to manually select those 2 trades and then send, like, then it's simply going to be a waste. So even at 2% per leg, like per for entry, 2% for exit of the calls and then the puts, I think is a pretty safe number to work with, right? So I'll just comment all of this in case you guys want to see this in the future. Convert profit values into numeric values. That is floating point. Floating point numbers are basically numbers that have a decimal in them. Plot profit, plot PNL, cumulative PNL curve, print cumulative, print PNL at end, print like final PNL. I'll help you guys out with the execution also. Bear with me, right? This is probably like people who have no idea of Python. This is probably a waste of time, and even to people who know Python, there's probably nothing new. And just going through the motions that are required. Extract CE and PE entry, comma, exit prices from the data frame into new columns. Right? I'm just for the sake of it, right? Convert CE, comma, C/P entry comma exit uh, values into numerical values, that is floating point numbers. Now compute slippage, display net profit, net cumulative PNM, that is profit minus slippage. Display final net profit. All right. So I think uh, just this graph itself shows you that, yes, even after like slippages and all will affect you, slippages and costs, but people, at times think, yeah, मैं इस पे cost लगाऊंगा ये तो zero हो जाए. Like that's not actually the case. Assuming you have some, defined slippage, you know, mm, parameter and you don't exceed it. Like if you're, like in this case, we have essentially computed costs. Like in this case, we have added like slippage and cost and everything as 2% of, each your entry, exit, whatever. Um, Now, if your numbers are exceeding that, in most cases, then it's a problem, right? However, if that is not the case, then you're good. That means the strategy will work exactly as it's showing you it will work, right? So, any questions with what I did with Python? Essentially, all I've tried to do is replicate, like, uh, you know, um, like adding slippages and costs and just showing that this is robust to them, like at least 1% slippage and not too much in costs will work. Now this is a single lot that we are working with. You'll probably, and यहाँ पे adding like too much costs would of course start adversely affecting the performance significantly. However, once you're trading say 5 lots, 10 lots, costs won't be as much like that. Usually when you're trading size, your commissions aren't as big a deal, especially with something like a discount broker, as much as slippages. So nothing to, I mean, again, do your own homework with this, do more rigorous testing. Shyam is saying in Odin you can place at SM, I don't know what he's saying. I've seen the price dancing. By saying I will take 3% including slippage. Bro, take 30%. Like that's up to you. If you just want to check how much, and we are going to add all of this to StockMock, the platform itself, very soon, where on the platform itself you'll be able to have like an option to move around the slippages and costs that you're assuming to see how robust your strategy is to those costs and slippages, right? So, but I mean, for now, this is I think like this does what we're trying to make it do. So what we have done so far is tested this entire thing on the in sample, and it seems to work. Now the only thing that is left is how much does it work in out sample, right? Which means key, if I change this from August 2019 to whatever the date is today, 25th basically, and now when I run this, do we still make a profit? Right now the average profit was 719. Does that amount of profit remain or not? Right? That's what we want to see. So let's see. So we run this. So it's profitable, yes. Now we have to just get rid of these nonsense days. So our overall profit went down as expected because we optimized for the in sample. And this is something you have to realize: whenever you go from in sample to out sample, your numbers will fall. Like it's almost like a given. Your out sample will almost never be as good as your in sample, as like assuming you're doing it the normal naive way. There are ways to do it better, but that will almost always be the case that your in sample will be better than your out sample, but it's still profitable, right? It's still making money on those expiries. So this is your full sample. Yeah, yeah, that's fair. Let's just do out sample. This is the full sample, so let's just keep the out sample data. This is the outsample. Right. So now let's get rid of the averages. So this is the outsample performance. Not as good as the in-sample, but still profitable. The question that we really want the answer to is it profitable after costs? So this is file number 2. So let's see what happens in file number 2. Yes, it's profitable. There's a drawdown, but then it picks itself up, makes about 12,000 points. Post costs, there's a deeper drawdown, but it is still profitable and makes post costs about 4,656 points after our slippage assumption and cost assumption of 2%, right? So is it like amazing? No, it's not. But is it profitable? Yes, it is, right? And granted, this has been like the high VIX time where selling would be a little harder to do than otherwise. But I mean, is it making you money? Yes. Like in the long run, it is, as long as you bear with the drawdown, right? So now let's just run the full sample. Let's run this. Let's get rid of the other days. Export as a CSV. This is number 3. So this is what the overall equity curve looks like. This is sort of where I'll just plot where the in sample ends and the out sample begins. At 49. This is where the in sample ends and the out sample begins. So does it make money? Yes. But is it super smooth? No, it's not. Right? Is it like this single-handedly should be your portfolio? I don't think so. You should have more strategies in there. You can play around a little more. And believe me when I tell you this, this is probably like one of the most suboptimal strategies that you can work with on StockMock. There are things here to be made that are so bloody profitable that it'll blow the cap off your head, right? So how much does it make? It makes like 30,000 points before costs. After cost, this is what the PNL looks like. Is it brilliant? No, it's not. It's a pretty deep drawdown, but it is profitable, right? Next is how much do you make? You make like 18,000 points at the end of the story. Now somebody asks, what is the drawdown, right? So how do you compute the drawdown? What we'll do is we'll create a new uh, column called net profit, because now everything we want to do is post cost. Now we have a net profit. Now net profit cumulative sum, and from that we subtract the cumulative sum, cumulative maximum. So this is what your drawdown graph sort of looks like, right? So small drawdowns and massive drawdown, then it picks up, and then it's good, right? So what is the deepest drawdown that you face with this? In this case, it is like just by looking at the graph, you can see it's somewhere like 8 or 9,000, and it is say 9,000 points, right? So the strategy made about 18,000 points and has a 9,000 point drawdown, and which is like a, even though this is not big enough a sample size to calculate the Kalmar ratio on, which would require at least 3 years. But with this sample size that we're working with, the return to drawdown ratio here becomes like a 2-ish, around 2 post costs, right? Now, if our costs were lower, say if you had like a 1% cost assumption, this would become, little smoother. Now your drawdown being much low and your returns being much high, right? So again, what floats your boat in terms of the assumptions and the drawdowns will be a very subjective thing. Now it being little above 3, which is pretty decent, right? So again, what you prefer and what your assumptions are, what your strategy is, and again, this is not like a brilliant strategy, but it's enough to get you started. Or I hope I've communicated the idea of what is possible with this simple prototyping platform, and then just a bit of so for this. What I'll do is I'll give you guys this Python notebook. So the Jupyter notebook. Let's name this and then QT StockMock enhance. Right. So I'll upload this on something like GitHub where you can download it from. So anybody who has, if somebody has even the basic Python proficiency, they can just do this themselves. Else, you can just download it, change the path here to your, what do you say, your folder path, wherever your downloads are, and you can, be happy, right? You can, I mean, when I say you can be happy, you can run all of this post-cost analysis to see whether this thing whether your strategy post cost works that you make on stock, right? Otherwise we will work hard to get the slippages and all these new things like drawdowns and car MDTs and all onto stock market itself as soon as possible, right? So a simple strategy for you guys to work with now. But and just for the sake of giving you guys something fun to work with, a better strategy is actually I will leave something for you guys to find, right? Because if I hand everything to you, then what will you do? So play around with the platform. Believe me, there's like much better things to create over here, and go wild. Uh, so here's so now that brings us to the end of the strategy creation, so to speak. We have the strategy logic, and now comes the execution, right? How do we execute something like this? So uh, the platform we'll use for that is this platform called Tradetron.tech. All right. Someone has messaged me saying, no, please share this strategy at 75%. No, but of course, I mean, if I share that, then what's there for you to do, right? I'll show you the path. I'll show you the direction to walk in. So just because I've shown you what is possible, that should be signal enough that there's something for you to discover, right? But the path to that discovery is for you to chart. That is not something that I mean, I'm happy to guide you along it, but I can't just walk the walk for you, right? My job, like Rhythm is saying, I'll not give you the fish itself. I've shown you how you can catch the fish. I've shown you how to fish. Now it's for you to go out there, sail, and fish. And again, if you guys play around, uh, that's again, this will take time. It's not going to be easy, right? If this was going to be easy, anybody could have done it. The reason I'm showing you the path is like, at least don't waste time with nonsense, right? Um, it. I'm sure, I don't know how many of you have done like other webinars, seminars, or whatnot. Other people are very happy to tell you, yeah, just go take this and trade and you'll make money with this. The reason they're happy to do that is what they're selling you is, garbage. However, what my job here is to show you guys the tools and the path you can take to achieve, that dreamland or that promised land that has been, sold to you guys by those other trainers, but which they of course cannot lead you to because they're selling trash. I'm not really selling you anything in this webinar, apart from like these tools that I'm showcasing to you. Um, whether you choose to use them or not is up to you. Now, some people will say, yeah, StockMock to paid platform. It's not really paid. Like it's, you have 3 free credits every day. So 3 free credits every day is like 90 back tests in a month, right? So I'm not even asking you to pay for it. Do 3 back tests today, and play around with it like the way we did, right? Shift something, aage piche upar niche, play around with the norms and see what does the data suggest. And again, remember the in sample out sample split, right? So what does the data suggest? With that, take into um, with whatever your takeaway is on day one, go back day two and see, all right, so right now I tested with time and I think this is how the time works, time for doing whatever I'm doing, exit for entry time. Now then experiment with exit times. Then the day after that, experiment with stop losses, then targets. And so just do this for a month, and after 90 iterations you're probably you know gonna have something. Again, like, even though my friends have access to the free, like when the platform was free, even they took some time to play around with the platform and make their strategy. So if you're thinking that you can just do it overnight, or I'm going to hand it to you, or somebody's going to just tell you how to make money out of the market, you're sorely mistaken, right? Unfortunately, or fortunately, this is not easy. It is simple. Like at this point, it's pretty. I've shown you what to do. It is just your job to go out and do it. Now, if you're looking to do like 100 back tests in a day, are you going to have to pay for it? Yes. But then again, you're paying for things anyways, right? Maybe if you don't have a solid strategy to work with and you're still trading, you're paying by just giving your money away to the market, right? If you're attending other like seminars, webinars, courses, whatever, just ask yourself, of all the ones that I've attended so far, what is the immediate actionable like information or insight that I've gotten out, right? The answer would probably be none, like zero, right? Maybe they'll give you some very philosophical bullshit to ponder about, but very few will actually give you something immediately, actionable, right? Probably because they don't have anything. So again, in my case, I've given you a starting point. Is it great, or would I put my money on it? No. Would I? Is it possible? Yes, most definitely. So Ray is saying he's looking for a Kalmar ratio above 4, which is, which I mean we've already achieved with StockMock strategies in the past. So I'm telling you it's profitable, or like it's possible. Profit factor is not something I use, so I don't know. You can find it after 50 tries, right? You gave up after 50 tries over a week. So what is a Kalmar ratio for, right? It's a 40%, more than 40% return against a 10% drawdown, right? If you can bear like a 20-25% drawdown on your capital, that means you'll double your capital in a year on just the simple return. If you're looking at compounded returns, you can probably make triple digits easily within a year. If that is what you're looking for and you're happy to give up in a week, I mean, I'm really sorry, yeah, but you're probably never gonna fuck 4. You'd be happy. Like you should thank your stars if you make money in the markets, right? Because a week is nothing. Think of the timeline you're working on, right? So again, Ray, work harder, right? Stick to it. Stick to the process. I've shown you how to do it, where to do it. Just do it, right? Now, Mahesh is saying scalability issue. Mahesh, what kind of capital are you looking to deploy? When you say it's a scalability issue, Gopal Krishnan sir, of course, it can be automated. I'm just going to show you a very simple way to automate it. If I even automate this, I'll show you guys a very simple way to automate. you can definitely trade 2 crores also on strategies made on this platform. I know this because I know people do. Now, is it a good idea to put all of that 2 crore in one single strategy? Probably not. So build like 5 different strategies, like a basket of different buying, selling, directional, non-directional, different times, different strategies, different days. So diversify across different strategies and then trade it. Putting 2 crores in any single strategy is stupid, right? So it is scalable, and it is even to, and I mean, if you're right now trading 2 lakhs, uh, whether you'll be able to trade 2 crores on a strategy is probably the least of your concerns right now, right? I mean, I'm not saying this in like a offensive way. I'm just saying, if something works on 2 lakhs, just pick that up and work with it. Turn that 2 into 20, turn that 20 into 40, 40 into 1, 1 into 2, and then, and probably when you're at like 50 or 1, that is when you should start worrying about what will I do at 2, right? Don't worry at 2 when you're already at 2, but when you're at least like halfway there or a quarter of the way there, right? Worrying about it when you're like 1% of that, like 100th of it, is probably not, I mean, you're just, again, it's back to mental masturbation, that यार ओके मैं 2 लाख पे तो मैं पैसे बना लूंगा, बट 2 करोड़ पे कैसे बनाऊंगा? भाई 2 करोड़ आने तो दो, जब 2 करोड़ आएगा तब तक तुम अपने आप ही अपग्रेड होने लग जाओ, राइट? तो राइट, just guys, again, I'm not trying to be rude or anything. I'm just trying to give you like the practical information and the advice that will work for you and work for your trade. uh, I'm not trying to give you some nonsense, right? Now Prageet is saying the Strangle seems better in backtesting, and that's great. What I'm now, I'll show you guys how to automate things. All right. Now, because now if you have a strategy, right, you're saying Strangle works better, there is a few more combinations for you to try, and you'll realize, oh shit, I didn't know this, but this works even better. Oh my god, you can, I shit you not, when I said you can make 5 to 15% every month at like very, like, you can break like 5 Kalmar with just StockMock strategies. I know somebody who has double digit Kalmars with StockMock strategies with a bit of their own twist to it, right? Again, it's all very simple conceptual stuff, but it's very much possible. So, all right. So where are we? So Tradetron, how do you automate this stuff, right? Now, this platform, if you haven't joined this yet, I'll give you guys the sign up link using which you can you'll be able to subscribe to all of the strategies that I'll be creating for free. So once you're on this, you can subscribe to I'll create some strategies here, both the one I've shown today and the one I'll show tomorrow. And also, who said that they wanted a 4+ Kalmar strategy? Ray, make sure you're around tomorrow because uh, your dreams might just come true. Harsh is asking how much was the return of your initial Nifty expiry options per month. Per month, let me just tell you. So, I mean, the Kalmar ratio over there was like 4.5ish. So, say depending on the drawdown you're willing to face. For example, if I am willing to take a 25% drawdown, I can make like 10% every month on those. All right. So on this platform, so I've given you guys the link to sign up for this platform if you already haven't. Now you go to create. No, there's no privileged link or anything. This sign up link that I've sent is like the link to sign up. Like there's no privilege on this link. It's just right. So the ex-wife was the name of another strategy I was testing on this platform. Oh, my bad. Uh, Not really. It's the same. I mean, they're completely disconnected. Like today's and tomorrow's are going to be two independent sessions, so there's no like sense of continuity lost. Again, it's the same process. Fastest finger first for tomorrow. So I hope you guys make it. I'd be glad if most or all. I mean, I doubt all would, but I hope most of the people who are there today will be there tomorrow, right? So now, again, this strategy, because it's on expiries, we'll call it XY. Uh, so XY here was also the name of that original expiry strategy that I'd created. But now I've discarded it. So this straddle selling that we've just created, and tomorrow's straddle buying, oh, sorry, directional buying on expiries, we'll both wrap into this framework, right? So it's super simple to create strategies with this, right? So I'll just call this uh, expiry options trading system, right? That's the description I've chosen for it. It's very simple. Now, what are the conditions, right? So now it will take you time to get proficient with the platform. There's some great like videos on explaining. Like if you scroll to the bottom, you'll see videos, right? Just use those, and that will get you up to speed on the platform. And it's a very intuitive platform to use once you get the hang of it, right? So entry just means what is the entry condition? When should a trade be entered? So I'll click on add. Now here I have to build the conditions, and you can build very complex things with this. But right now, fortunately, our logic is super simple, right? All we have to do is on 9/17 on Thursdays we have to enter, right? So first I have to take the keyword called time, the time on the NSE, so it'll let you choose which exchange. So right now, all of these would be the same time except the NASDAQ, right? Because this platform lets you trade in the States also. So the NSE, when the time is equal to, now you express time here as a number. The number we have is 970, right? So now this is the first piece of the logic, but right now this will just run every day at 9:50. So what I want is I want to add another condition where the weekday on the NSE, again, it'll let you choose on which exchange, is equal to. And now again, you have to express this as a number. Now they start counting from 1. So 1 is Monday, Tuesday, 3 is Wednesday, 4 is Thursday. And that's it. We have just coded up the logic for our strategy that we just created here. That's it. Now positions, like what this is basically asking is, what position do you want to take when this condition is fulfilled, right? Here we have just told it the conditions, right? Now what are the positions? So I want to sell on the NFO exchange, which is the NSE futures and options exchange. I want to sell a call on the Nifty bank, the underlying the bank Nifty index. The MIS is the intraday order. So an ATM strike, the current peak, and that automatically selects like the current monthly, which is expiring that week. Let's just work with one lot. All right. So one thing I did not address, like how much capital should you have to say trade this, right? Now, I mean, the way we have created the strategy, this is what we've ended up with, though there are a few better strategies to be created even within this framework, if you do it like a little more carefully. And if like the simplest modification to this is, I think if you just hold it all the way till 315, again, now here, this would qualify as, tinkering with the parameters in the test. But this is how we originally created it. We did not tinker around with the exit time, because fundamentally it made sense to just hold the expiry, like hold till the end of the expiry. That's one thing you can do, and it'll backtest. And this actually is okay, Shpaf. And oh, actually, because we're doing automated entries, let's do 916. This is going to enter automatically. Let's do this. I'll just show you guys 916 holding all the way till the end. How much, um, you know, post costs, what can we expect? So this is like pretty solid. Export this as a CSV. Do the same kind of analysis. far smoother equity curve. Yes, one big drawdown spike, but not as bad as last time. So this time we're making like 30,000 points at almost like a 7,000 point drawdown, right? Now, for how much money should you have, right? Now that 1 minute will make a difference. 916 entries, because that's where a lot of the premium is lost. But now because with Tradetron we're entering automatically, we can use that, right? If you want to go back with this, again at this point we'll be tinkering on, like we'll be working with burn data and you know, yeah, and you could even tighten your stop loss to like 200 points or 250, 300 points and make those numbers look better. But I mean, I don't see the point in doing that right now, because we know these numbers are good or good enough. I mean, we can work with those. Is there a significant increase? I don't know. Let me just import this also and see what do we get. Right. Doesn't really change much. I mean, if anything, I think the earlier one was better. I mean, this we had already, like, not using this, but with a, like, different way of just analyzing data. We've just checked that it's almost uh, better to just hold till the end. Like, and not just for, expiries, but even in general. So let's just work with that framework for now. And you can, feel free to mess around further. But let's just stick with this, right? So let's make this, just for the fuck of it, because we have automated execution on this. We'll just change this number to 916. Again, don't work with burn data. Don't tinker once the test has been done. But I'm just doing it here for the fuck of it. But like, this is not good practice. I'm telling you in advance. So if this, like, if you're using this for your research purposes, or like this is how you're testing, do not do this. Now, so now the important question was, how much money should we have? Like, so this is step one, right? Our profitable strategies here. Ray's asking, how do we round up? It's always how do we round up ATM strike to -100 in Tradetron? Well, I don't get the question. Like, how do you round up? I mean, oh, you don't have to worry about that. When it says ATM, it already knows what the ATM will be. For each instrument, they've logged there what are the strikes, what is the difference between each strike, and how will you identify the money. I mean, again, people are very smart when they build these platforms. I mean, yeah, there are times when uh, if it's 11,555, whenever there's a 5, wait, 11, why will it take 11,200? Eh? Ray, I don't know what your question looks off. 11, 6. Again, just ask yourself which one is it closer to. Come on, I mean, all right. Now I think everybody's worried about the edge case. For example, if the one strike is at 100, the others at 200, and the price is exactly at 150, which strike would it choose? This could be like could be specific to the platform or something. But again, this is an edge case because it'll be very rare for your price to exactly be that. Number one. Number two, even if that is, it is almost by convention that you're at that point, you round up, not down, right? So 150 gets rounded to 200, not 100, is the usual convention. All right. So, but again, besides the point, coming back to the money you should have to trade one of these, right? So all of these numbers are with one lot. of Bank Nifty options. 76,000 is sort of what I think the margin per lot is. Something like Zerodha. Wait, how much? No, I think they've modified it or something. No? Can someone tell me what is the margin per lot right now for this? It's 75K, right? All right, cool. So this is showing 30,000. 30,000 ही लगता है almost. Cool. So this, and let's say you're working on something like Zerodha, which gives 2.5 times leverage, if I'm not wrong. So 30,000 is what you'll be working with. Yeah, so intraday. Now you'll be having two lots in each trade, one call, one put. So that's your per lot margin required. Now, next is what is the drawdown, right? This is the drawdown. I'll just call this MDD. On like these two lots, this is to add the drawdown to your margin required. Then we'll round this up. What I'll do is I'll say divide this entire number that I have, 67,525. I will divide this by, say, 1,000. Round it up. Like round it up as in like upwards. Yeah, I'll go to the nearest upper one. Or actually, let me just round it to nearest that, and then multiply it by 10,000. So 70,000 is what you should. So actually, you should multiply your drawdown also by 2 for the future. So 80,000 is what you should have to trade one lot. Actually, no, you should multiply this also just to be safe. You can never be too safe in trading, right? Let's say by 1.5. So let's say 1,20,000 is a safe number, so that even if you had twice the drawdown and like even more, right? Say almost 2.5x the drawdown or something. With 1,20,000, you're very much cushioned. Some people will say, yeah, oh, this is overcapitalized. That is the stupidest shit I've ever heard. Like, there's no such thing as, I mean, at least not at this difference, something called overcapitalized. If you have, say, 100 crores and you're only using 10 lakhs, then you're probably overcapitalized. But if if half of your trading margin is almost being deployed, so at 1,20,000, if you have, and 60,000 is being used in a single trade, or around 60,000, so half your trading margin is being used almost on a daily basis, right? So this isn't overcapitalized. This is very well capitalized, right? So this can bear drawdowns twice the amount that might be expected, or maybe 3 times, 4 times what might be expected. So this is safe, right? You don't want to get rich overnight, that, and because that won't happen. But it is very much possible that if you trade wrong, you'll go broke overnight, right? So go for this. Just be comfortable, right? 1,20,000 is how much capital you should have to trade one of these. So what I'm going to do here is I've added one call and I'm going to add one lot, and I'll add one. Right, so what have I done here? I've added one call and one put sell as what it should do when this condition is fulfilled. So at 9:16 on a Thursday, it should just sell a call and a put. All right. So that's the entry criteria. Now the exit criteria, in this case, it's called the universal exit because there's one entry criteria. If you had multiple entry criteria, this would just be called exit. And a universal exit would be a different thing. But in this case, because it's just one condition, it's called the universal exit. It's a very simple thing. Again, what was the plan? So in this case, we're modifying this to 960, right? When are we squaring off? Let's just square off at 245, right? It doesn't matter. This is when we'll square off, or when my PNL is less than 400. So what I'll do is, there's a keyword that returns the PNL itself. It's called the PNL, right? When this becomes less than or equal to a number, that number being minus 400, that is when it should exit everything. All right. So now just look at this. It's pretty simple. You've added the conditions, you've added what it should do when those conditions are fulfilled, and you've added when it should exit those positions, right? What position is it entering? It's selling a bank nifty at the money ATM call and an ATM put of the current weekly expiry, one lot of each, right? This is stuff you'll get used to. Again, watch the videos. They'll probably, it'll probably become clear. So now let me just take questions, right? People are asking, Tradetron compatible with all discount brokers? Did you? All right, wait. Let me just save the strategy first. So now here's something fancy you can do, right? In the advanced settings, how would you like to enter? Right, most people here just use market price. I like to use something fancy. You go for the average of the bid and ask, which is the mid price. Revise it 2 times, increasing it by 1 tick each time. And if that doesn't, and modify this every second. And if that doesn't work, then you execute at market price. So what is it going to do? It is going to fire an order at the mid price. Then in 1 second, if that isn't filled, it will fire again 1 tick further in. Then if that isn't done, then it will revise one more time, 1 more tick inside after a second. And even if that doesn't work, it will just fire off a market order. All right. So this is, and you can, there's a bunch of other options that you can play around with in terms of your execution with Tradetron. Then there's the tranching where you go in piece by piece, you slice your orders. Now reactivate on exit is 6 hours. So this is essentially, after this universal exit is done. So essentially all your trades are done for the day. Then you should, it should reactivate 6 hours later. So essentially the next day, like 6 hours later, it'll then start looking for this condition being fulfilled again. So this could be more, liberal, like more liberal, just saying, 12 hours later. But never mind, just do it 6 hours later or even 5 minutes later, doesn't matter. Actually, don't do it. Actually, 5 minutes later also won't matter, right? So now capital required, I'll put 1,20,000, right? That is the capital that will be required. So take trades 1 second, like I'm allowing it to trade as soon as the exchange opens. Check conditions continuously. Now I can do that because I have a portfolio manager account. When you start with this, I mean, you won't be able to, like, it won't implement it continuously for you, simply because your account won't allow that, the free account, but mine does. So if I've created the strategy and you subscribe to it, it'll do it, right? It'll work. And now, is this a public strategy? I'll make it public. So all of you guys can right now, with the link I've sent you, just sign up for Tradetron and subscribe to my strategy, and you'll be able to see it in the marketplace. I'll just show it to you guys, just to show you what it will look like. So I'm just making this free. Display positions. I won't display it to non-subscribers. You guys can see it. Confirm is hide subscribers. Recreate old positions. Everything is good. Create, and it's done. So now, what have we done? We have just implemented a strategy called the XY, which is then, or at least the first part of the XY. The second part comes tomorrow. On 9/16 on Thursdays, it'll enter, and it'll sell a call and a put at the money at that time, and it'll exit if my PNL becomes lower than 2 or 400 rupees, right? If I lose more than 400, right? This reactivate on exit after, just you could set this to 2 minutes, doesn't matter. Just set it to any number less than like 12 hours or less, or 12 hours or less. So what happens is, after, so for example, you're running some conditions, then for example, in this case, this is the universal exit. After this, we don't want to do anything, right? After this, our trading ends. So then it will just stop searching if this condition is true, because it has nothing to do then. And I'm saying, all right, so the next 6 hours don't check for these, but after that, start checking them. So in our case, we can make it even 12 hours one day. We can actually make it 7 days also. Actually, we can't make it 7 days. We can make it one day also, because we only care about Thursday to Thursday, right? We aren't putting 315. Oh, हाँ, exit condition में वो भी तो डालना था. Sorry, my bad. Thank you guys. So another condition is time. If my time on the NSE, thank you Abhinav, is greater than equal to what are we exiting 15:15, right? So यहाँ पे, because you're expressing everything in a 24-hour format, so the 3:15 p.m. is going to be 15:15, right? So this, and here it isn't supposed to be an and, it's supposed to be an or. Either this happens or this happens, I'll exit my positions, right? Again, thank you Abhinav. So this will exit all open positions in this set. This set is defined as this. These are the positions that will be open, and hence you're good. So now I'll update this and I'll click on deploy. Now the backtester on this is still very, very slow and barely has any data, but I'm sure they're working on it, and it'll be much smoother soon. So now you'll see a strategy called X-Wife by Vihan Singh. So if you go to strategies, marketplace, in the marketplace, you'll see a bunch of other strategies that you can explore, see the performance of, see how they're doing. And if you just in the search go for X-Wife or just Vihan Singh, you should see the X-Wife, right? So you can subscribe to this. So Sachin is already subscribed. Thank you, Sachin. So I'd advise you guys to just head on over there. If you don't have an account, I've sent the account creation link, the registration with my own referral, right? So now every Thursday, this will at least on paper start trading this strategy, and it'll show you whether it makes money or not. Now, if you want to, if you subscribe to this and you want to deploy, it does allow you to do that. That's on your subscriber end. So now Shri is asking if you want to allocate 10 lakhs to this strategy, will it automatically take 8 lakhs? So here's how that works. So when you subscribe to this, it'll show you like a multiplier. How much do you want to multiply this thing by? So for example, if you were putting 1.2 lakhs only, you'll multiply that by 1. Like the multiplier will remain 1. However, if you were putting say 6 lakhs, you'll put the multiplier as 5. Guys, whoever's using the annotate, don't. All right. So if you're deploying 6 lakhs, just use the multiplier as like into 5 and you're good. All right. Sandeep sir, yes, it does have 15-minute OHLCs, and that is what we'll be working with tomorrow. So I'll show you what else is possible. So tomorrow we'll work on a different kind of strategy, and we'll see how to deploy it on Tradetron. Yeah, some people just don't learn. All right. So what are the brokers that are compatible? Good question. So we go to the main website. Let's see what all brokers are compatible. Even I don't know. Maybe you go to partners and it'll show you. All right. So here are the brokers. And it's a lot of, I think it's almost every broker worth trading with, right? So Zerodha, Fires, Master Trust, Alice Blue, Composite Edge, Nirmal Bank, Upstock, Sindra Securities. Pretty much every broker that you could think of, or at least every technology-enabled broker that you could think of is covered, right? So, and then, on your end, and if you just go to those videos, it will tell you how do you link this to your broker, how do you deploy, so on. All of that is available in the videos, right? So what you can do now is just go subscribe to this strategy. Tomorrow we'll continue building on this, and so right now there's like a straddle selling component. Tomorrow we'll add like a directional option buying component. Tomorrow, instead of using StockMock, I'll be using Python, and I'll be doing like a very simple data-driven technical analysis on options data to show you how simple option buying strategy can be built using that information. So yeah, I mean, if you want to deploy with money in it, then you'll have to take a subscription. So again, if you think everything good is coming for free, then you're mistaken, right? So like uh, the retail is like 1,000 rupees a month. Like even if you were to go to Zerodha or Upstocks, just your API would cost this much, right? So it's much better to just go for this, or if you want like the high speed condition checking and everything, just go for the portfolio manager one, which is like 5,000 rupees a month, and again it's very much doable, right? I don't know how much you guys like in terms of capital you're looking to deploy. For paper trading, you can do it for free. Paper trading, you all you have to do is go just click on subscribe, and it should let you deploy, right? uh, Srinivas is asking how reliable. I mean, it's as reliable as your broker is, because your broker is where this will be executed. Now, the broker I would recommend is Master Trust, simply because we have been burned by Upstocks, Zerodha, like the bullshit brokers, at least in my opinion, right? If you're working with them and it's working well, great, like go ahead. But my suggestion, like all our own trading is now shifting to Master Trust, and worked with them and understood their operations fairly intimately, and I can tell you that it's pretty solid, or like far more solid than one of these discount brokers is. So um, that's what my suggestion to you would be. So but like otherwise, feel free to explore other options, like on the other brokers or whatever your broker is, right? Cool. So that brings us to the end of today's webinar and the content today. Any questions? Any questions? Sandeep is asking if I have a strategy and everyday script needs to be changed. Every day I need to update my algo. I mean, I don't know exactly how you mean. Again, everything can be automated here, but you'll have to elaborate on what exactly your what your requirement is with your changing scripts. So Nandkishore is asking, while deploying a strategy, how many times do we face tech issues or orders not getting executed? Again, how many times? I really don't sit down and count these kind of things. I doubt anybody does. Primarily these issues, like at this point, it's like people building applications on APIs are able to do it very well. If anything fucks up, it's the broker's backend at this point. So if you ever encounter issues with with your own trading, with something like Tradetron or anything, it is very very likely that the issue is not with something like Tradetron but your broker, right? So Suraj is asking, have you ever tried any strategy with the martingale principle? I have not. I mean, we've tested it, and even though it can be profitable, it just won't. I mean, I'm not comfortable trading something on the martingale principle. Um, Arun is asking any documentation on what variables are present and how to use it in Tradetron. Again, if you watch the videos, they go over those things. I am not sure about the documentation yet. Let's see, use cases, features. Not here. Features, features at your disposal. All right, there you go. These are the keywords. Yeah. So if you go to features and you just scroll down, you'll see something called keywords, and these are all the keywords that you can use. I'm sure more will be added as time goes on. Uh, but and maybe there are more already, and this just hasn't been updated. I'm not sure. Position builder, you can choose, with strikes, uh, Greeks, time to expiry. There's a lot to learn about this platform. Like, it's a very, very comprehensive platform, and you can, spend quite a while learning about it. So do do check it out, right? Oh shit, I wasn't sharing my screen, so I don't think you were able to see this. My bad. Uh, my bad. I'm really sorry. Let me just share it again. Right. So if you go to on Tradetron, if you go to if you just scroll to the bottom of the page, you'll see something called features. Click on that, and now if you scroll down here, it'll say called keywords, and here all of them are listed. And then how do you use the position builder? So there's a lot of reading to be done here. So go ahead. Going back. Um, Mahesh is asking, do we have execution problem if you subscribe on free plan? I mean, you won't have execution problems simply because it will only be paper trading. So you can't have any kind of execution problems, to be honest. Pratap is asking, do you use any other platforms? Like StockMock is only for options. What if I want to test cash for futures? I have not tried any other platform, nor do I wish to. Whenever I want to work with cash or futures data, I just do it in Python. So can use Blitz Trader as it is directly connected to broker. I mean, it's up. I haven't. I don't know what Blitz Trader is. I think it's one of those Symphony technologies, but I haven't used those. And, I mean, if you want to, feel free to. Someone's asking, do you use fixed fraction or fixed ratio for scaling up or scale? I mean, I'm not even going to answer that. I mean, I'm not going to answer that because I can't. Is it possible to do delta hedging? Someone's asking, do we not test these on weekdays except expiry? Please do. I mean, test everything. There's nothing lost with testing, right? You'll probably just get information about what works and what doesn't. More of what doesn't than of what does. But everything that doesn't work added to your repertoire, you just have lesser things to think about, right? Is it possible to go with delta hedging, sir? I'm not 100% sure. If you'd like, I can check with the platform guys and get back to you, or you could just probably ping them directly. They're very helpful. Both Umesh sir, who started this, and his team. So Suraj saying back to the with martingale, someone showing around 45%. Suraj, I have no idea how you back tested this, what that 45% return is against in terms of drawdown and capital and whatnot. So, I mean, I really can't comment on it at all. But again, if you're using martingale, be super, super, super careful. Um, Thank you, Vishal. Saxena sir is saying non-expiry days are better. I don't know. Try it out, sir. I mean, if that's the case, that's great, right? Let's check it out. Manas is asking why Linux? Why not? Why Windows? Why, definitely not like Mac. Like, that's garbage. And Windows is also like buggy garbage. So Linux it's just I was actually planning to switch like almost like 2 or 3 years ago, but I dual booted both Windows and Linux. I just wasn't able to make the shift. I was like, fuck, I'll just boot only Ubuntu, and I'll only use that. And eventually it'll just force me to get used to it. And now that I'm used to it, I like it. I also doubt like any serious developer or coder uses anything but Ubuntu, or like anything but like a Linux distribution. Someone's asking me if I've tested delta hedging. I've not in the Indian markets at least. What's the best time period to buy? Again, guys, if there's one takeaway that I would like you all to have from this is try to simplify as opposed to complicate. It's even if you were, you'll have a insanely hard time unless you're like a coder with like a solid infrastructure in place. Implementing like manually, it's virtually impossible to do it properly. Automated also, you'll have to do it very well to achieve, at least what is theoretically supposed to be delta hedging in practice, and it's probably not going to be worth the effort you'll put into it. So Sham is asking what's the best time period to backtest. Again, there's no best time period that I can think of. I'd suggest 3 to 5 years for intraday strategies is decent, and like more like a rule of thumb, if your backtest has like 300 to 500 like 300 to 500 trades overall, it's pretty decent. Now Nand Kishore ji is asking, most welcome, sir. Thank you for attending. We have overshot exactly by an hour. Now, yeah, it's entirely on you to research further, execute, do your thing. From this point on, it's entirely about how much effort do you put in, how much time do you put in, right? Nand Kishore is asking, we created on StockMock, deploy on Tradetron. What was the point of Python? That was just checking for slippages. That even after slippages and costs, does a strategy made on StockMock remain profitable? And like that is all I was trying to show. That will be part of StockMock's platform itself very soon. So you can do all of that in one place, and very soon even execution will become a part of StockMock. So you won't even have to go to another platform. In a single platform, you'll be able to do everything, right? Now, again, a lot of you will probably want like resources and things, where you can learn this, that, or the other thing. Tomorrow, at the end of the webinar tomorrow, I'll spend like 15-20 minutes, half an hour, just listing out resources, what to go, what to read, what to attend, what, like, I'll do that for tomorrow. So, right. Again, most, I'm thankful to you guys for attending and sticking around. I hope to see you all there tomorrow, same time. Again, I'll drop the link 15 minutes before start. Again, I've just given you guys the information to actually like start making money on this. Go do your own research, do your own analysis, play around, and make money. If you keep learning, keep learning, right? So learn something new, right? Learn about something new. Whether it be a skill, whether it be like a new paradigm, learn a new strategy. Just keep learning. Mana Singh is saying, would like to hear more about your journey, incidents of your time. Unfortunately, bro, I now have somewhere to be. Like, I knew that up until 3, I have no problem, but 3:30 onwards, I have another commitment. So I have to prepare for that. So I'll be bringing this to an end. We can catch up, later or tomorrow. Right. So, yeah. All right. So if there are no other questions about the content of today's webinar, I'll bring this to an end, and then we'll meet again tomorrow. iPhone 11 is saying, I'd like to meet you someday to discuss things. Absolutely, sir. Feel free to ping me. And, once this Corona thing is over with, we'll definitely meet. Right. All right, guys. So I think there are no further questions. So I'll bring this to an end. Thank you, everyone, for attending.
We meet again tomorrow 11 a.m. Link will be on the AlphaX Markana group at 10:45, and we'll probably tomorrow. I'll probably be a bit more constrained for time, so we'll probably wrap up at 2 p.m. itself. And hope these 2 days make you a better systematic / quantitative trader. And wish you all the money and profits in the markets. See you.